is Monday, November 28th. Hope you all had a great Thanksgiving holiday for those of you who celebrate here in the U.S. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sozzi. And we are seeing a bit of pressure on the futures here in the U.S. this morning. And that's because of developing situation out of China overnight and really over the past couple of weeks. Here we're looking at the global map and you see some of the selling pressure that we saw in Asian markets here. Hong Kong down 1.5%, Shanghai down about 0.75%, and that selling continuing over across Europe. Those prices are way on your left there over for the U.S. markets where Friday's closed. But let's get to the futures here this morning and see what is happening. Effectively, we are seeing more and more protests happening over in China regarding zero COVID policies. We've been talking about these protests now for several weeks, but they ramped up over the weekend, becoming more overt and more unusual. And then some of the protesters were actually calling for political change within the Communist Party or even democracy in China, which is very unusual to have that happen in the open there. You can see here futures down about 0.75% here in the U.S. if we're looking. And it's not just there that we are seeing this in evidence, really seeing pressure on things like crude oil because China is such a big market for crude. If there's going to be continued pressure on the economy there, what does that mean for crude? Not only that, we are now seeing crude is lower for the year to date, ticking below that zero line. So now down about 2.7% year to date. So all of this ripple effect that we continue to watch us.
All right, let's stay on those protests and dig into it from a health perspective. Joining us now is Yahoo Finance's senior healthcare reporter, Anjali Kamlani with more. Anjali.
That's right, Brian. As Julie mentioned, of course, we saw these protests erupt over the weekend in cities like Beijing, Shanghai, and Wuhan, the epicenter of the original outbreak of the pandemic, all because of these stringent restrictions that China is putting back in place after recent case spikes across the country, especially affecting these larger cities. And that's been a concern as we've heard rumblings over the past few months, first with the lockdown in April and May in Shanghai, as well as subsequent months, the restriction of access to food, access to medical care, even in one instance, lack of availability of fire transportation to reach on time to a fire. So all of these things have been building up over time. We've seen how that zero COVID policy has really been putting pressure on Chinese citizens, and the concern that they've had about this ongoing, since the start of the pandemic, that zero tolerance. And of course, we've heard about over the past several weeks the pressure that that President Xi is facing, to the point that Julie made about comments about democracy, about no life-term presidents, all of that coming to play in what is essentially a public health crisis in China right now, with the government choosing a very stringent practice in order to help keep cases down, even though they're fighting quite a transmissible subvariant of Omicron right now.
Anjali, while we have you, one of the numbers that's coming to light as well is the number of people that would need intensive care treatment if some of the zero COVID policies are dropped. 5.8 million people. What would the impact to the healthcare system look like in China if we do see the removal of the policies as well?
Absolutely. That's the concern. Of course, overwhelming of hospitals. That's something we understand and have dealt with over here in the U.S. The need to build out more capacity, quarantine centers and the like. China was already pulling back on that, if you recall, easing international travel and the isolation time, not needing to use these centers as much or for as lengthy a period of time. But now in recent weeks, we've seen the need for an increased use and definitely some commentary about the increased capacity that's required to handle the spike in cases. So putting pressure on an already, pretty pressured system over the last 3 years. We know all about that here now as we have this triple-demic sort of hitting us here in the U.S.
Thanks so much, Anjali. Appreciate it. So now the question is, you guys, here in China, when we talk about the authorities in China, will they change their policies? There were some glimmers of it. Goldman Sachs out in a new note saying the chances that China's going to reopen before the second quarter of 2023 are 30%. I think that's actually unchanged from what Goldman thought before. But what it's saying now is that it could be a forced and disorderly exit. There are so many questions here because China has put so much, the Chinese authorities have put so much stock in this zero COVID policy. There's a lot of question about whether they want the appearance that their hand is being forced by the protesters. And that really sets this up for a volatile situation, which is obviously what we're seeing markets react to as well.
And that's what markets were bid, or they have been bid up over the past month on this notion that China would be reopening. You mentioned it this morning, Julie. You've seen a lot of Wall Street notes over the past month come out bullish that almost 2023 will be just a different China. And that is now a thesis that is now coming under attack. And it also dovetails with another note from Goldman Sachs saying they remain relatively defensive on stocks for the next 3 months. They recommend investors stay overweight cash. That is a big call by Goldman.
One of the other notes within here, or at least portions of this note from Goldman, they're saying that within that 30% probability that you mentioned, that probability of reopening before Q2 next year, it also dovetails into where this also impacts some of the GDP forecasts for China as well, citing high-risk districts accounting for 65% of the national GDP within China. And then this also comes at a time where we had already seen some economists start to pare back what their expectations for growth would be in 2022 and even into 2023 as well. In 2022, they're expecting China's growth to slow to 3.2% here. And so now you've got, of course, the policies that have already been more strict and enacted now at a time of the year where we typically do see more of these spikes in cases, and where that may protrude even more so into 2023 could have a larger impact into 2023's GDP forecast for China.
And it also has to do with supply chain.
Yeah.
And what we had these glimmers of hope about supply chain, that things were finally starting to normalize. And now you have these potential disruptions. And of course, Apple is one of the companies that is most at the center of this, because many of the protests in China began at Foxconn plants where Apple products are being manufactured. There's a Bloomberg story out this morning that there could be a shortfall of up to 6 million iPhone Pro units this year. They're citing people familiar with the situation. They could then potentially make those up in early 2023, that production. But even so, we're going into the holidays. If they don't have as many phones as people want, that could potentially be an issue.
Well, I'd say the concern, you could feel it on our ticker pages, top ticker on our site, Apple, and our friend Dan Ives, his note, really good note by him making the rounds this morning, saying he's seeing a major shortage in iPhone Pros this holiday season. Also thinks he's at almost 10%. He thinks there could be a 10% shortage of iPhones. So the Bloomberg story says 6 million. Dan Ives at about 10% just shortage. I mean, these are big numbers for a company like that.
Yeah.
Well, let's continue the conversation in terms of what this means for the holiday season and more broadly here as well. Consumers did spend a record $9.12 billion on online purchases this Black Friday, despite inflation concerns, according to data from Adobe Analytics. Some of the hottest items sold were, get this, Fortnite, Funko Pop, and Xbox Series X there. So got a range of categories that are touched there, but all of them somewhat touching gaming there. So one of the underlying themes that you could perhaps point to. And within this Adobe data, it was interesting in how they were able to kind of lay this out here, because I was looking at one of the charts that kind of gave some of the inclinations, or at least gave some of the data around where we did see these spikes in purchases that were made. And let's also think back to October, where so much of that purchasing, that demand was brought forward as well in the deals for days from Target, from Walmart, and then Amazon Prime days even being moved forward. And then now you fast forward to what we already knew would be a high demand and yearly cyclical period where they did see that $9.12 billion in revenue. And that was just on Black Friday alone there.
Yeah, there's a small wrinkle to this latest Adobe data that just hit about 30 minutes ago. They made it a point to say this is not just reflective of inflation, these sales numbers, but even if they back out inflation, Adobe is saying they saw sales up slightly year over year. But look, even if you were to beat last year's record sales by a dollar, obviously the numbers would be a record this year. But I'm looking at some of the notes out here from Wall Street. Right now, a city is saying they saw underwhelming store traffic, and they saw a cautious consumer. And at least pre-market, I know the market is under pressure here, but you're not seeing these retail stocks at least suggest that the holiday season has got off to a bang-up start. A lot of concern out there, and it's being reflected in the space.
Because it's costing them.
Yes.
Right? The other thing that Adobe highlights in its forecast, by the way, that consumers are going to spend between $11.2 and $11.6 billion today alone on Cyber Monday, is all the discounts, all the sales that are happening. Record discounts for computers, which peaked at 27% off listed price. Great deals, they say, can be found in nearly all categories. Apparel, 19% off. Toys, 33% off. Electronics, 25% off. Everything is on sale. You guys see it in your inboxes, as I'm sure all of our viewers do too. You've been getting that flood of emails. And so, that's why perhaps we know that what's going to happen in the margins of some of these companies.
And it's not just some of those. Citi calling out heightened promotions in appliances and grills. So that grill replenishment rate under pressure, Brad.
The refrigerator replenishment rate is under fire as well. Deflationary period being signaled there. And
by the way, Adobe says the best day for a deal on appliances. December 1st.
Well, I need a new washer. Help me out.
So wait until December 1st. That's when discounts are set to peak at 18% on average, according to Adobe.
Love it.
You got to get the dishwasher that lets you check the status on your phone as well.
I mean, because why not? And anything else would be unacceptable, Brad.
That's innovation.
Yeah,
kitchen innovation.
Yes.
This is in the broader context of the NRF forecasting that holiday retail sales between November and December are actually going to grow between 6 and 8% over 2021. So the total figure that we're going to be kind of keeping tabs on and tracking towards is somewhere between $942.6 billion and $960 billion.
I was checking out my detergent.
I was going to say, every time I see you looking at your phone now,
I'm checking out my detergent.
I'm
No, I'm just kidding. I definitely don't have one of those. Do they
No.
exist, though? Is that a thing? You can check your detergent and stuff?
The appliances? Yeah. Oh, yeah. I mean, it's in dishwashers, washers, dryers. Yeah. I mean, they're just
I like
more
little pods.
connected.
I like the little gel pods. They're kind of cool.
As long as, yes.
Yeah.
Yes.
Okay, investors are facing a flood of economic releases in the week ahead as we head into the final month of trading this year. For more, let's bring in Yahoo Finance's Alexandra Semenova. Oh man, we got a lot happening this week actually. We got Fed speak, we got economic data. It's going to be busy.
Oh yeah, I hope that investors fueled up on Thanksgiving leftovers this week because it is going to be a busy few days. We have the government's monthly employment report, data on the housing market, a second reading on GDP growth, PCE, and a reading on consumer confidence in the days ahead. And those are just a few of the highlights. Still, though, it continues to be all about the Federal Reserve for investors. They're not just looking at these reports as snapshots of the economy, but they're looking at them as cues for what the Fed will do next. And the two most important ones, of course, are the Labor Department's monthly employment report for November. Bloomberg estimates are looking for 200,000 jobs created last month. This would mark a moderation from the prior month, a welcome sign, of course, for investors. But again, this reflects that hiring is still robust. Pre-pandemic hiring stood at around 150 to 200,000 jobs a month. So any surprise to the upside here could be a little bit concerning for investors. We also have PCE out, the Fed's preferred a measure of inflation, and Bloomberg estimates are looking for an annual increase of about 6%. Again, also a slight moderation, but again, inflation is not coming down nearly enough. Bank of America's fund manager survey out earlier this month said investors don't see a pivot until PCE comes in at around 4%.
Interesting. So what's Wall Street saying about a Fed pivot or a pause? I don't know if we've rebranded it yet or kind of reframed it at this point.
Yeah, I mean, investors are optimistic that we finally might see a downshift in next month's rate hike from 75 basis points to 50 basis points, and they're looking at a pause at around May. But it's not, as excited as investors are about, a slowdown in inflation and a pause. A lot on Wall Street have expressed concerns about the outlook. The picture isn't rosy. BlackRock said that we're in a new macro regime where central banks are causing recessions rather than coming to the rescue. Bill Ackman last week said that he has doubts about the Federal Reserve's ability to bring inflation back to its 2% target. So even if we do see this highly anticipated slowdown in inflation and a pause next year, the outlook for growth and equity markets isn't looking so good.
Yahoo Finance's own Alexandra Semenova with what to watch this week. Big week ahead here. Thanks so much.
Thanks, guys.
You guys, coming up, why our next guest says that there's a 50-50 chance of a recession in the U.S. Timing is everything, though. We're going to discuss next. Continuing on with our discussion on some of the largest protests in China seen in years as people fight COVID lockdowns. Markets are reacting negatively, fearing the impact on China's manufacturing as the holiday season begins in earnest. Joining us now for more, we've got John Augustine, who is the Huntington Private Bank CIO. Thanks for joining us here on set today, John.
Thanks for having us.
Absolutely. All right, to start things off with what we're seeing right now in China and how that kind of has a more outsized impact from your perspective. What do you believe are some of the biggest areas that could be reactive or continue to be volatile as a result of what we're seeing in China?
Well, markets are reacting the way you'd think so far this morning. Stocks down, commodities down, bonds up, except one thing, the dollar's down. So it'll be really interesting to watch this afternoon to see if it impacts European markets this morning, but then we have some rebound action in the US this afternoon. So China does more trade with Europe than the US. So we're seeing Europe stocks down a little bit more today. Obviously commodities, that impact obviously Apple. But it's really Europe that's the epicenter with China more than the US right now.
If the situation in China, John, continues to escalate, is that enough to push the US into a recession?
Probably not. We're a pretty closed economy. About 15% of our economy is exports. So we're fortunate, we're pretty closed in that environment. Probably the Fed's going to have more to do with the recession than China will. But it's going to slow down some big companies. Yeah, it's going to slow some things down. And Apple's the one today, and every day we'll probably discover one.
Okay, so let's get to the Fed then. If the Fed, I mean, and that's pretty, I think there's broad agreement that the Fed is the big risk factor, right? Or a big risk factor for U.S. recession. So how are you gaming that out at that point? At this point, what do you think is going to happen?
So our call from our economic team, Fed goes 50 on December 14th. That'll put them at 4.5. The expectation for inflation next year is 4.3. So that may give them, if they want, a reason to pause. Now their next meeting won't be till February 1st. You know, it's thought 50, 50, 25, then the following one's in March. But if they get above the expected inflation rate next year, if they want, that should give them a reason to pause. We'll see. More to come, obviously.
Interesting. Okay. And so with that, where do you believe that the economy will stand at that point?
We're thinking the economy may be a little bit better than expected.
Interesting.
So it's really uniform right now that earnings are going to be down, S&P 500, GDP is going to be down first half of next year. To us and our equity team and economic team, it's a little bit too uniform. And right now we're going in this fourth quarter, we're 2/3 of the way through the fourth quarter, where the Atlanta Nowcast model says the economy is doing much better than economists think it's doing and the Fed thinks it's doing. So that'll be interesting as well. So we may be going into next year with more upside economic momentum than downside, even though our economy always slows in the first quarter of the year because it's cold out. But we may be going in with more upside.
Well, you know, we're coming up against the year end here, John. Are you seeing any customers or any clients take some interest in tech stocks? It's been a horrible year, notably in big cap tech, but these stocks can't go down forever just given their cash positions.
Not big cap tech yet, but some small cap. So for instance, our equity team, the other week, they bought some Electronic Arts, but then they bought some Emerson Electric. So they're kind of coming in baby steps, smaller tech, probably large tech. You want to keep some, obviously it's so big in the indexes now. But our equity team's underweight, but the moment the Fed utters, yeah, we're about done, they're going to scream up.
And John, it's interesting that Saz asked about clients because you guys are private banks, so relatively high net worth individuals. Are you seeing any change in their sentiment as we get towards the end of the year, especially with what stocks have done this year? Are they changing what they want to invest in, what they want to spend on? What are you hearing from them?
Cash. So cash yields 3.5 now. But I hadn't done that since 2007. So for the first time in 15 years, cash and bonds are interesting. Now we caution them, okay, that's fine, 3.5 is fine. But if these accounts, you want them to grow over the inflation rate for the next generation, that's not going to get you there. There's a lot of happy retirees in Florida right now who are finally getting some interest on their savings they haven't had for 15 years. So cash is where we're seeing the most questions right now because it's not zero.
But is it because of the yield or is it because they want safety or
Yield.
both? The yield. Interesting.
The yield.
Huh.
All right, let's leave it there for now. John Augustine, CIO at Huntington Private Bank. Good to see you. We'll talk to you soon.
Thanks, guys.
Coming up, we'll dive into a few hot tickers on Yahoo Finance as traders return from the long holiday weekend. We'll be right back. Welcome back. We're coming up against that opening bell on Wall Street to kick off this jobs report week. Let's take a look at some stocks moving on the Yahoo Finance platform. First up, casino shares in focus after the Macau government renewed the licenses for 6 casino operators, including resorts from Wynn, MGM, and Las Vegas Sands. The new licenses are expected to take effect at the beginning of next year and are allowed to carry a maximum term of 10 years, according to Macau's gaming law. JP Morgan now with a flash down on this one, guys, saying this could be a big catalyst for the stocks. They're recommending pretty much buy ratings across the board for the space as a result of this.
Yeah, we've seen tremendous growth in terms of post-pandemic period where there has been more attention that's been thrust towards gaming, whether that be digitally or whether that be the in-person experience, and particularly for some of the resort operators, as we're seeing even this kind of shift in traveler sentiment and how they are spending more money on those experiences versus goods, at least cyclically right now. You wonder where that could continue to move forward, or at least kind of set a new benchmark rate that some of the casino operators could count on. But we do know that negotiations, they're going to continue with some of the winners that got the final contracts. And then also, they've got to have some type of investment in non-gaming sectors as well, which is going to be an interesting kind of tidbit of this.
Yeah, I mean, it was pretty expected that they would get this. Still, it was a sort of an overhang and uncertainty. And it's so interesting how these stocks trading today stands in stark contrast, or this positive sentiment stands in stark contrast to what we're hearing from the mainland. But to put it in perspective here, gaming revenue in Macau is down to a record low of $49 million in July. That is a 98% decline from pre-COVID levels. And part of the reason is that Macau is so dependent on the Chinese mainland. That's where most of the visitors who come there come from. Chinese gambling is still illegal in mainland China. It is not illegal in Macau, obviously, and these new license renewal promises now guarantee that it is going to remain legal in Macau for now at these various casinos. So, it's a big deal that they're able to do this, but they're also trying to diversify where the travelers come from to come to Macau. And, that'll be an interesting challenge going forward to see if they can attract people from other places.
This would have been a disaster if they didn't get these license renewals.
Yes.
These companies have invested billions of dollars over the past decade to put large hotels and properties and tables in these areas, and clearly they needed this.
Yeah, Macau gets cited time after time, especially in the earnings calls for companies like Wynn. Wynn actually talking about that within their most recent earnings call as well, saying that the market continues to be challenging. Of course, the current environment. However, these contracts certainly give them some legway going forward from here. They're saying that the unique tourism offering during periods when the market is accessible really is highlighting some of that strong demand that they are forecasting and foreseeing, which really dovetails into how they go about getting these contracts and the competitive environment for making sure that they do get that 10-year time period too. So we'll see exactly where they're able to start to enact some of that as the negotiations start to finalize as well here. We're also tracking shares of online therapy counseling provider Talkspace. They're skyrocketing this morning on a report that the company could be bought out by the American Well Corporation for $1.50 a share, or $200 million here. Now, here's the context about this, of course, because there's been so many leadership changes within kind of this Talkspace turmoil that's been taking place since the time that they've been going public. There was a lot of scrutiny about when they went public and that it was somewhat of a cash grab. First Time Ventures has, of course, been one of the most noteworthy, most vocal investors that holds a large shareholder position in Talkspace. And they had poked at the company previously, but again, they were worth about $1.4 billion when they went public. And so now $200 million is their valuation.
Well,
the whole space has
60 cents.
Yeah, the whole space has had a valuation reset. All these upstart telehealth companies, I look at some of the, what is the one that Kathy Wood owns? That has come under, under considerable pressure.
Yeah, definitely. Talkspace, remember, was the company that was Michael Phelps was the spokesman for this. And we saw a lot of these mental health startups in particular. Yes, you had telehealth generally, but mental health specifically also was sort of seeing a boom here, not just with ones where you interact with someone, but meditation apps, things like that, that really had a boom during the pandemic when the easy money was flowing, right? And all of these companies were getting a lot of investment. So this is indeed quite a come down here. Amwell reportedly would be doing a stock deal for Talkspace, which is interesting as well. And we'll see if indeed it ends up happening here. Because the newspaper that reported this is The Calculist, so we have not gotten a confirmation of whether this deal is actually on the table. That's the buy. That's the company that's buying them.
That one too. Awful.
Yeah, they're both
two steaming piles just joining forces.
Many of the charts in this space are trouble-looking charts, to say the least. So that's where we find ourselves this morning. As we set up for the opening bell, I missed the joke. Besides,
you did.
We were filling the blanks.
It's okay.
Yeah.
We appreciate you just carrying, that 30 seconds.
I'm just going to pretend I don't hear any
catch up after the
discussions
show.
about Tide Pods nor steaming piles.
See, you did hear it.
Various uses.
I heard that. Yes,
Various
I kept
uses for
going.
Tide Pods.
I live in a house of boys, so I'm used to zoning out the poop comments and just keep going.
I've been zoned out.
Come what may. All right, so we're setting up for the opening bell on Wall Street in just a few moments here, you guys. And if not quite a steaming pile this morning, we have a little bit
You're going to use it again. You liked it. You just don't want to admit it.
A little bit of a decline here in this, as we see this enthusiastic remote opening for the U.S. markets.
How do you say that name?
Morning.
Kraft?
Kraft. I think it's probably Kraft.
I was just trying to figure it out. I don't know.
If you were Donald Duck, yes.
Yeah, right. Kraft.
In any case, as we look at the setup here this morning, Saz, you referenced it briefly earlier, right? The Goldman note that we get a Goldman note every Monday, right? But Goldman talking up the recession chances, right, in its most recent note.
Yeah, I encourage everyone, when I go to yahoofinance.com, you can see the story I read up. It's about 300 words, quick read, share with everyone, but them outlining that at least from a broader market perspective, a recession next year is not priced into stocks. They're recommending people stay overweight cash. What does it mean in plain English? They want you to have more cash in your portfolio than stocks.
All right, that's kind of similar to what we were hearing from John Augustine a few moments ago as well.
Yeah, indeed. Well, taking a look at how we've opened up here just after the opening cross, you've got the Dow Jones Industrial Average up by lower by about 0.3%. We've opened here on the day down by about 112 points for the Dow. Nasdaq Composite, that's lower by about 0.7%, 70 points to the downside there. And then the S&P 500, you're seeing that lower by about 0.6%. On this Cyber Monday, I want to take a look at some of the retail names that are also on the move here. You've got Amazon, that's higher by about 0.7%. Walmart, as well as Home Depot, also in positive territory, and just kind of putting this on an equal setting here just to get a good look at where you've got some of the divide that's taking place. Oh yeah, surprise, surprise. Bed Bath & Beyond, that is down by about 3%.
I think they're still trying to get people through the door for Thanksgiving. Good luck.
Yeah. It's the foot traffic concern as well as the heavy promotional environment right now. Macy's as well. That's down by about 0.6%. We'll keep an eye on that one as we move forward throughout the day. But interesting catching a bid for Nike. You've got Foot Locker. We're going to have an interesting discussion later on about the resale market even in this holiday season too. So stay tuned for that conversation.
We will indeed. And despite Thanksgiving being over, we're locking in on some shares of food makers, shares of Tyson and Beyond Meat in particular this morning. They are both trading lower after being downgraded and also their price targets being cut over Barclays. Both of them going to underweight from equal weight due, Barclays says, to the difficult outlook surrounding protein companies in general, although the downgrade didn't affect all of the protein companies in Barclays coverage there. But they said the worst is yet to come for most of the sector because price-conscious consumers are facing rising prices for a lot of these products, as well as rising beef prices. So that's a challenge for some of these companies.
I'm concerned on what the worst is yet to come would mean for Beyond Meat. You can argue they've seen the worst the past year. Consumers have traded off of that product and traded down to cheaper regular alternatives like regular chicken, regular beef. So that's a scary note from Barclays on Beyond, and even to a lesser extent Tyson.
You know, one of the interesting things, I was looking back through the Beyond earnings report as well, and they're actually down for the 9 months that we've seen them report for thus far over the course of this fiscal year. They're actually down in every single category across U.S. retail, U.S. food service, and even international retail food service. So negative just kind of negative percentages that you've got across the board. So that is declines across the board there in their revenues. But here's the interesting thing. They're actually up in some of those key categories in terms of the pounds sold by channel, which is interesting because it means that they're actually taking a severe discount for everything that they are producing. So the overproduction met with the lower prices that they're able to just sell through some of their own inventory that they're creating, that creates a longer term issue if you're Beyond Meat or Impossible Foods, because that's a larger demand equation. And they had to cite that within their most recent earnings report as well. They had talked about this on the call, just saying that current economic climate has not been time to plant-based meat. I mean, no crap, but honestly, it really is this question of whether or not this is a transitory period, and everybody hates that word when you hear it on an earnings call. But this doesn't necessarily have the same history in the meat environment in a cyclical or an economic downturn period as some of the more kind of historical meat, if you will.
Historical meat. Yeah, I mean, we had tofurkey on our Thanksgiving table.
Legendary meat.
OG meat.
Classic meat.
For the vegetarian in our house. But I learned tofurkey is made by a privately held company.
Tofurkey?
Tofurkey. It's not bad, actually. But anyway, it's by a privately held company. But we saw Beyond Meat shares just now trading a little bit higher today, but the stock is down 80% year to date.
You would have a better idea than me, probably, Julie. I saw 2 Beyond patties in Whole Foods for $5.75. That's pretty good. I mean, these used to sell for $8 a pop. Too expensive, though.
Yeah, I guess that is. I mean, it's funny to me that they sell them as patties because you can buy the pound of the stuff. Mm-hmm. And I guess they do that with ground beef too. Like, it's so difficult to shape.
See, I knew you'd have more knowledge.
You would have more knowledge.
I knew you'd have more.
Nobody wants to do that.
I guess not. You just wash your hands afterwards. But yes, that is certainly than when they first came out. That is a lower price than we saw the introductory price when Beyond Meat was the new hot thing.
Gosh, that looks
on
good.
the market.
Those
right?
photos. I like the plant-based food. I'm Impossible. I like Beyond. To me, it tastes great.
On your breakfast sandwich too?
Yeah, anywhere I can get it.
Yeah, I like that stuff too. All right, coming up, Yahoo Finance's Jared Blucher is going to break down the latest market actions, kick off the trading week. That is next. Welcome back to Yahoo Finance Live. Let's take a look at markets, which are down a little bit in the red, not too steeply, though. Let's get to Jared Blickery at the Wi-Fi Interactive. Stand in front of the map here today, where I'm seeing a lot of red.
Yes, we're kicking off the week on a red note here. You can see the Dow down about 0.1%, S&P 500 down 44 basis points, Nasdaq down about 30 basis points. But let's take a longer look at the S&P 500. This is the benchmark. This is the kahuna. This is a year-to-date look of the S&P 500's performance. And by the way, the record high for the S&P 500, by way of reminder, that came on the very first trading day of the year. So that is a record high over there. You can see still not even climbing about halfway through that. Now, right here, not shown, is a 200-day moving average. It's also been a sticking point over the last few weeks. So I'm going to say 4,000 to 4,100, kind of a big level that we're going to be watching in here. Now, Tom Lee over at Strat had an interesting forecast of 4,400 to 4,500 for the end of the year. That's a big distance to traverse for this index in a short period of time. But he does note that there are 11 tailwinds, or 11 headwinds of the year, which have really formed into tailwinds. Interesting analysis. I don't know if that the speed of that move is going to point to 4,500, but I will say this: if it can break out of this resistance area, and the dollar also at the same time can break below its 200-day moving average, not shown here, it would have to go below that. That is a possibility. Now, if on the other hand, if the S&P 500 falls from here, if the dollar bounces off that, probably going to be sideways to down action. So let's take a look at where we are in terms of sector action for the day. More red than green, although consumer discretionary, those retail stocks on this Cyber Monday, those are outperforming. That's XLY there, followed by healthcare, XLV, and staples just barely in the green. To the downside, energy down about 2.5%. Let's take a real quick look at crude oil. CL equals F. It's down 2% to the lowest point of the year. Let me show you a one-year chart. So you'd have to go all the way back to, I guess, last December to really get to where the price action here. So below 75, kind of a big move for crude oil, just like I was talking about the S&P 500 and the dollar at their respective 200-day moving averages. China stocks, got to talk Pinduoduo for a second. Huge blockbuster earnings. Citi noting that this is the second blockbuster earnings report in a row, basically doubled the street's estimates in terms of profit. That was up 4 times over a year ago, and also doubling revenue estimates. So pretty good results for Pinduoduo. Chinese stocks bottomed before just about everything else this year. So maybe a bellwether, maybe just kind of one of those one-offs, guys.
Jared Blickery, thanks so much. All right, let's fire up our stat of the day for this Monday. Next year will be the year of zero, says Goldman Sachs strategist in a new note. Goldman Sachs sees S&P 500 companies having zero earnings growth in 2023. They also see zero appreciation for the S&P 500, in large part because profits will be stagnant for S&P 500 companies. Straight ahead, StockX CEO Scott Cutler stops by with a look at what brands and styles shoppers are buying this holiday season.
More shoppers are turning to the secondary market this holiday season, with StockX seeing over 500,000 searches for top brands like Jordan 4s and Nike Dunks. Joining us for more on what to expect this Cyber Monday, we've got StockX CEO Scott Cutler. Scott, great to have you here with us on this momentous occasion, I'm sure, in terms of the site traffic and the volume that you typically see. What are some of the top searches that are coming through here on this Cyber Monday?
Well, we kicked off Black Friday with a spin to win challenge, giving our customers the opportunity to win unique prizes such as apparel for the year, sneakers for a year. And Black Friday was up on a year-over-year basis, despite the fact that it was a challenging and continues to be a challenging consumer environment. I think for us, the top sellers continue to be in the category of sneakers, Nike, brand Jordan, but we also saw a lot of cross-category shopping this year across accessories, apparel, electronics, which was really exciting to see.
Scott, how widespread is the discounting on the site, if any?
Well, we're a marketplace, and so that marketplace, we connect sellers and buyers. Our promotional activity is more aligned to trying to drive sellers to sell more and create a better pricing opportunity for our buyers. And so since we're not in the process of selling our own inventory, it's coming from sellers. We want to create the right incentives for sellers around the world to reach our buyers, which come from over 200 countries and territories around the world.
Hey, Scott, it's Julie here. So I guess I'll ask this question a different way. What's happening with pricing on your platform? I see the numbers in your report, and it looks like most of those are the number of sales of the shoes, if I'm reading it correctly, versus the pricing. What is happening with pricing? Are you seeing any kind of decrease in the year-over-year rate of price? You know, we obviously, as we're looking at inflation broadly, it's not about prices going down, it's about prices going up at a lower rate. What are you seeing on your platform?
So as a real-time marketplace, price always reflects supply and demand. And so dynamically across the portfolio, prices change, and they change by the minute. Certainly for those products that see the highest demand, you see the highest price appreciation, certainly relative to retail. I think this year for the more value-conscious consumer, you're seeing a lot more purchases of transactions, particularly like in the sneaker category. One of our top sellers would be the Nike Air Force One white, which would be a lower price point opportunity. I think in other categories, consumers are able to find below retail pricing opportunities. I'd say across the board, again, prices are very dynamic, but for the value-conscious consumer or the hype-beast consumer, they have the opportunity to make choices around pricing, particularly because it's so dynamic on our site.
Well, okay, so what choices are they making, Scott? I mean, surely you must have, I understand what you're saying about price dynamics, but surely you have some insight into, there's more demand for the lower-priced sneakers right now versus the higher, or even the in-demand sneakers are not topping out as high as they were before. What kind of signals are you seeing?
Well, the holiday releases are always a big driver of traffic, and Jordan has a tradition of releasing in-demand colorways just in time for the holidays. This year, one of the styles that created the most buzz and actually the highest price premiums was the Jordan 1 Chicago Lost and Found, a classic colorway. It was a top 5 throughout the weekend. The number one seller was also a Nike product. It was the Panda Dunk, which has held the number one spot throughout the weekend. But it was also the women's sizes and the grade school sizes that really saw traffic. But we had some surprises. Crocs this year, maybe you were into the clog Sasquatch Croc. This was just released this month. It was a top 25 item. New Balance ranked as top 5 brand overall on Black Friday, which was really great to see. A classic colorway in the 550 silhouette was a top seller. And then even in apparel, we saw shoes, which has been a new category for us, Uggs, boots, and slippers, really being, again, a top seller going into Black Friday, but really we saw a surge over the weekend as well.
I am not in the cozy Sasquatch camp or demographic here, Scott, but what I am interested in and was interested in was that Jordan 1 launch, the Lost and Found, which there was a lot of controversy around it because some of the sneakers were found to have mold on it. Was that the case at StockX for some of the partnerships that you've had with Nike over the years as well? You've been able to have access to some of that inventory to sell through to your site. Were you seeing any of those complaints either emerge on the platform? And what do you have to do to rectify some of those issues as well?
Oh, we have a comprehensive approach to make sure that the products that are being received by the buyers, we verify those products. And we go through a rigorous process of verification to review all sorts of different conditions. So, for example, we examine whether or not it's the right size, it's the right product, if there's any manufacturing defect. In this case, if there was anything wrong with the sneaker, we would stop that product from ever getting to the buyer. Any signs of previous wear, or in fact, if the item is fake. This last year, we rejected more than 300,000 transactions from getting to the buyer, products worth more than 100 million in value. And so that's our way to ensure that that buyer is getting exactly the product that they want through our verification process.
Scott, just lastly, while we have you, over the last several weeks here, we've had some controversy within the broader kind of sneaker touching landscape, especially when you think back to kind of Adidas and Yeezy, and then even Balenciaga and their latest ad campaign coming under fire for that. StockX is a platform that kind of sits at the intersection of some of that inventory that does get resold as well. And you know, I wonder if there are any substantive changes that in those instances StockX decides to make that are material to either how those products are listed on the platform or just how they are sold through, or any changes in the customer and purchase intent that you're seeing on the platform when these issues do arise.
The StockX has zero tolerance for anti-Semitism, racism, hate, or discrimination of any kind. And while StockX has a wide range of products that are inspired by creators, artists, athletes, their views, their actions, their belief are not always a reflection of our own. But also as a resale platform, products that are being sold on our platform are from individual sellers, not the actual brand or not the actual athlete. And so we don't have any corporate partnerships nor direct financial ties to those that have been caught in the controversy. But that being said, I think consumer preferences are always reflected on the site. And so you'll see demand, again, grow or wane in products that, quite frankly, are no longer popular.
Scott, good to see you. Scott Cutler, CEO of StockX. Thanks.
Thanks so much.
Coming up, Saz is zeroing in on one retailer this holiday season. It's one he didn't like so much in the past.
Yeah, I wonder what it is.
We'll tell you next. The biggest weekend in retail officially comes to a close today. Is it still the biggest weekend in retail? And of course, Brian Sozzi was paying close attention to everything from sales to the parade. And that's where we find his take today. We're finding hope in one specific, much maligned retailer.
Well, that's me.
Formerly maligned.
I find inspiration everywhere. And today on our site, and this story shooting up the Yahoo Finance homepage now in our morning brief newsletter, looking at Macy's, and I was really inspired to see, Paula Abdul at the Macy's Thanksgiving Day Parade. I think she crushed it. So did Mariah Carey at the end, absolutely crushed it. That's our lead photo on this. And that really sent me back to looking at Macy's, a company that I've been super, super critical of the past really 3 years. They were slow to close stores. The inventory looked absolutely terrible. You couldn't find an associate in the stores to ask basic questions, such as like opening up a fitting room. But I going back and looking at the fundamentals of Macy's, I have to tip my hat to them and give some credit where credit is due. The stock pretty much this year has outperformed the S&P 500, basically, I would say for 75% of the year. That is a good indication, I think, that you're doing something right. Next, inventory levels at Macy's are at some of the healthiest among rival department stores. And that really reflects, I think, management and CEO Jeff Gennette drilling down on what should be in these stores, what should not be in the stores. And I think Macy's has been more inclined to stock less in stores just to keep the margins coming into the business and not being under a lot of pressure like they had been. Same-store sales outperforming rival department stores such as Kohl's. Kohl's is having a horrible year. Now, Macy's sales are still under pressure, but again, relatively outperforming Kohl's and some of its other competitors in the mall. And then lastly, too, one that has not got talked about enough is Bloomingdale's. Bloomingdale's sales in the most recent quarter were positive, which looks very good compared to the likes of a Nordstrom, which saw negative same-store sales in its most recent quarter. Now, people that I've talked to related for Macy's for this story point to a couple factors driving this performance for the company. One, they've gained a lot of market share from JCPenney. I appreciate what Mark Rosen told us a week ago on the JCPenney turnaround, but still, JCPenney has closed hundreds of stores, and finally, it looks like that traffic has been shifting to the likes of Macy's. Secondarily, experts also point to weakness in Nordstrom, just getting their assortment right, and those shoppers have, believe it or not, went from Nordstrom over to Macy's. So that has been a theme within all of this. My take for Macy's here for this particular story, everyone has it within themselves to change. That is me, and that is also Macy's too. I think they deserve a little bit of credit here for their year that has been this year, a pretty good year considering how pressured the consumer has been. That is me, I'm guessing at the Thanksgiving Day Macy's parade. Channeling my inner Mariah Carey.
But with the green hair styles are sticking around too.
Oh, it is the Grinch. Wow. No, it's not the Grinch. Come on, Macy's had a pretty good year. No, not the Grinch.
Yeah. So here's the interesting thing though too, on the inventory side, there's still so many of the retailers that are still trying to muddle through or trying to figure out how they can, where the consumer, in the direct-to-consumer environment, where you've got some of those brands that have decided we're going to pull back some of the inventory as well, and we're not going to sell in through you at the same scale that we used to before.
Well, Macy's at the point now, it'd be really sad to see vendors not selling in Macy's. I think they've closed a lot of just terrible stores, and they're operating really in some of the top A and B malls in this country. And just really quick, go back to that Grinch photo. I'm being told that my heart has grown for Macy's this year, hence that Grinch photo right there.
How many sizes did it grow that day? The Grinch's heart?
Three sizes?
I think that's right.
Oh, it's part of the movie?
Yeah.
I don't remember.
Yeah.
Oh.
Maybe 10.
Maybe 10?
10.
I can't remember.
Somewhere between 3
we're
and
going to
10.
look it up and get back to you.
3x10.
I still don't like Kohl's though, sorry. Or Gap.
Well, guess what? They're going to both be banking on some Black Friday sales here.
Or Bed
Coming
Bath.
up, Black Friday sales hit a new record this year as customers scoured the internet for deals. We'll speak with Bernstein's Anisha Sherman. That's next.
Howdy, welcome back to Yahoo Finance on this Monday morning. I'm Brian Sozzi here with Julie Hyman and Brad Smith. Markets are taking it on the chin post-holiday as concerns mount on growing COVID protests in China. Right now, you're seeing all three major indices decisively in the red. Now, here's what's on tap for this hour. 'Tis the day to shop. We'll look at the start to the holiday shopping season on this Cyber Monday and have a few top picks from Bernstein analyst Anisha Sherman. And inside the mothership, Yahoo Finance's Ali Garfinkel is live from inside an Amazon warehouse to get a sense of how much people are spending on this Cyber Monday and tracking Apple. Apple stock remains under pressure on China COVID concerns. Wedbush analyst Dan Ives says he is seeing major iPhone 14 Pro shortages in large part due to these China lockdowns. Brad, over to you.
All right, we're taking a look at the major averages here with about 32 minutes into today's trading session. We've got the Dow Jones Industrial Average down right now by about 0.5%. You're taking also a look at this chart that gives you a year-to-date view here as we've got just about 2 days left. Yes, just 2 trading sessions left here in November, outside of today's, of course, where we're going to be watching closely for any type of or any inklings of a Santa Claus rally, but we'll be watching this very, very closely here. But again, down year to date for the Dow Jones Industrial Average by about 5-6% there. Nasdaq Composite, you're seeing that's down by about 0.3% here today, 33 points lower. And the S&P 500, you're seeing that lower by about 0.6%. Then also checking in on some of the major movers that we're tracking here on the day. I'll take a look at the Nasdaq 100 here. Here on this Cyber Monday, you're seeing Amazon up by about 2% there. You've also got some interesting moves that we've been tracking in the form of PayPal. PayPal is up by about 2%. Also, JD.com here on this Cyber Monday, that's up by about 2.4%. And then additionally here, we had gotten some data from Adobe out earlier today, just looking through some of the forecasts for this holiday season. And we're going to dive further into that in a hot second. But lastly, before we get to that conversation, let's just take a look at some of those retail names here. Again, you're seeing Amazon higher, but Walmart also up by about 0.3% and Target up by about 1.8% here on today's trading activity. Some heavy digital investments that those two companies have made as well to really gear up for a day such as this. Well, shoppers spent a record $9.12 billion online despite record inflation. That's according to data from Adobe. And deals are expected to continue through the holiday with Cyber Monday shopping currently underway as retailers look to clear house. Joining now with more insight into the retail landscape is Bernstein's senior analyst Anisha Sherman. Great to have you here with us today. From your perspective, do you believe that Black Friday, Cyber Monday are enough to get companies and their balance sheets into the black, given that this is still going to be a heavy promotional period this year?
I think it's going to take a toll, but I don't think it's going to be enough to clear the excess inventory they have. So, I think it takes a toll on their gross margins. I think it gets them in the black as far as, kind of higher sales and higher absolute profits, but they're going to take a major margin hit from the clearance that they're doing over this weekend and over the coming week. But more importantly, one of the biggest concerns these last 6 months has been on inventory levels, where everybody is running at record high inventory levels. And I don't think that clears as a result of Black Friday weekend. I don't even think it will clear in the next kind of couple of weeks. I think most brands and retailers will start 2023 with an inflated inventory position, which will take another quarter or two to clear properly.
Anisha, will one of those brands with an inflated inventory position into next year, will that be Nike? I went to a lot of stores over the weekend. Not only was Nike stuff discounted and very prominent, but there seemed to be a lot of it everywhere.
Yes, Nike has been doing aggressive clearance of product over the last month or so, and especially into Black Friday. It's primarily apparel product, and even within that, it's primarily seasonal apparel. So think about, more summer and fall gear that they're selling off on clearance because they don't expect it to sell full price going into kind of the winter and the spring. But what the company has also said is they have a lot of new stuff coming in. So fresh product that they want to put out on the shelves starting in the new year, which they can't do yet because the shelves are filled with old products. So they're trying to clear as much as possible the old product. They have guided to a big gross margin haircut this quarter as a result of all that clearance. But their view is better to clear it and take the margin hit and then start clean rather than let it linger on the balance sheets for another 6 months. So I think that's the right approach, but I also think it's not going to all clear this holiday season, and they will have a little bit left over to whittle down over the next few months, but will be in a much better position than many other brands because they are taking such an aggressive stance to clearing it over the holiday season.
Anisha, it's Julie here. The likes of Nike has also taken a more diversified approach to manufacturing, right? Given the pandemic. They tried to make adjustments. Other manufacturers have too. I'm curious with the latest news out of China about the protests there and about their ongoing difficulty with reopening. Are there any implications for apparel companies or other manufacturers as a result of what's going on?
Over the last year, we've had so many different restrictions and lockdowns in China. And what many of the manufacturing brands, apparel, as well as other kind of hard goods, consumer products have done is protect their manufacturing facilities by kind of isolating workers, testing them, keeping them within the facility when there is a citywide lockdown to be able to continue running the factories. I think they will take, I expect factories to take some of those same measures to avoid vast factory shutdowns in China. But for Nike specifically, I mean, China is a major region, but the bulk of their footwear, 50% of their footwear is made in Vietnam. So from a footwear perspective, the bulk of the volume is coming from other markets. And then apparel, though a good chunk of it is made in China, about 20%, apparel is much more easily diversified. It's less R&D intensive. It's easier to substitute other producers. So I don't think it will lead to a huge supply crunch for Nike specifically.
Anisha, kind of supplementing our discussion that we had with Scott Cutler from StockX and even one that we had a few weeks back with Farfetch and where they're going to continue to move forward there, and Goats, Eddie Liu. With regard to the resale market and what we may see this holiday season, it's not so much about where there's going to be discounting perhaps, but where you might see prices that are relatively lower for same products on a year-over-year basis, where some of the resellers just can't move through the inventory that they've listed on those platforms. Is there anything that you're seeing that sticks out within that resale market right now this holiday season?
Yeah, I think we'll see exactly that because, as we've come off a year of really high pent-up demand where people have been spending on product, think about a year ago, right, at the end of 2021, people were gearing up for a super strong 2022. They were buying at a much higher rate in that holiday season. This year, people have said they're going to cut back in holiday spending. So I think that goes for gifting as well. So if you're talking about the resale market as a source for both collectibles as well as gifting, I think that demand does take a toll relative to where we were a year ago.
Anisha, one brand that may not be seeing cutbacks is Lululemon. I visited a couple of Lululemon stores as well over the weekend. The place was packed and there were really no discounts. And, I'm not tracking pricing on products anymore. It's not my part of my gig here, but the prices felt much higher year over year.
Well, we've seen both data in both directions. So when we track pricing and promotions, and Lululemon has always historically had a much lower markdown rate than most or all of its competitors. The markdown rate, the percentage of products marked down hovers around sort of 10%, maybe going into the low teens. But as a contrast, Nike is over 40% at the moment. Adidas is over 40% at the moment. So most other brands are discounting very heavily. Lululemon is still in the kind of low double digits range. On the other hand, they're participating in Black Friday sales. I was surprised to see some of their newer lines, golf, tennis, shoes, also as part of that Black Friday sale event, despite their having said that the supply of those products was especially tight this year. So they do have an inventory situation. Their inventory is incredibly high. They're trying to hold on to it, and rather than put 40% of it up for sale, they're trying to kind of drip feed it over the next 6 months to preserve their margins. But they are, they're part of the problem as well. They are in Black Friday. Their new products are in Black Friday, so they are going to see a gross margin hit as a result of that as well.
So when I think about a brand like a Lululemon and the pricing, or even a Nike and some of the pricing that we've seen there, it all comes as there's been a shift towards how they're really putting together their business in this direct-to-consumer environment as well, and deciding what of that product goes out to some of the other wholesale partners. For Lululemon, it's been largely direct-to-consumer, but for the pricing, have you started to see some of that pushback on pricing from consumers? And honestly here, I mean, we were just talking about the sweaters being way too expensive, just out of this world expensive for Lululemon. Are you starting to see both consumers push back on pricing, or even the direct-to-consumer strategy be an inventory hedge at a time like this for some of those companies?
So in terms of pricing, I mean, we've seen bifurcated demand this year. We've seen at the same time inflation pressuring lower income consumers,
while simultaneously pent-up demand is fueling higher income spend. And both those trends have played out over the course of this year. And so we've seen it in the results, right? Lower income value retailers have posted comp declines and misses, while some of the mainstream and higher end brands have posted double-digit growth in North America concurrently. So that bifurcation, I think, is starting to compress. We look at the consumer data. We did a survey of more than 3,000 consumers a few weeks ago, and we saw a change in tone versus when we did it a year ago in terms of people cutting back more into holiday, cutting back more into 2023. And it's not just the lower income shoppers, it's more middle income and kind of slightly going into the higher income brackets as well. So I think we haven't seen a resistance to price increases yet, because those mainstream and higher income consumers have been more than willing to absorb it. But that may be starting to change. And we have heard from some brands that they're pausing price increases in 2023 versus, kind of holding their position, but not further increases, because of their anticipation of a slightly softer consumer. But on DTC, I think you're right. I think DTC is a hedge against promotions. If you don't have a lot of product that's sitting with wholesale partners, you're not going to see a ton of product marked down in the market, because you have control over your inventory. And Lululemon is a great example of that, where they've made the decision to hold on to their inventory, to sell it over a longer period of time, to carry a higher inventory balance, but reduce the number of markdowns in the market. And you can only make that kind of decision if you have an almost or completely DTC business and you are in control of all of that inventory.
Well, a little nugget for your research, Anisha. The guys' golf stuff, it just fits too small. I cannot bomb drives in their shirts. I have tried. I just can't do it. Bernstein's senior analyst, Anisha Sherman, always good to see you. We'll talk to you soon. Before we head to break, let's call up shares of Best Buy, sitting on the retail theme on this Cyber Monday. City analyst Steven Zaccone says Best Buy offered higher discounts year over year on TVs, laptops, PCs, and gaming equipment during the holiday weekend. Zaccone is staying with a sell rating on Best Buy and sees the stock dropping 11% to $72 a share. Coming up, possible lead exposure is resulting in a recall on over 10,000 children's bottles. Julie is back with a look at today's top headlines next.
Let's get a check on some other headlines we're watching now. Chevron is resuming oil production in Venezuela after U.S. sanctions halted all drilling activities almost 3 years ago. The company received a 6-month license from the Biden administration that stipulates that any oil produced can only be exported to the United States. That move comes as the government of Nicolas Maduro held its first formal talks with Venezuela's opposition coalition in more than a year and reached an agreement to implement a humanitarian program and continue negotiations. Chevron is the only U.S. oil company remaining in Venezuela. Senior leadership at Adidas discussed the risk of continuing a relationship with Kanye West as far back as 4 years ago. That's according to a new report from the Wall Street Journal. A 2018 presentation to members of the Adidas executive board highlighted the risk to employees interacting with Ye and detailed strategies for maintaining the relationship. But instead of parting ways when the concerns were raised, the Wall Street Journal reports executives instead pitched proposals on how to maintain the Yeezy partnership, which accounts, they say, for roughly 8% of the company's sales. And Green Sprouts, a company that makes natural products for babies, recalled over 10,000 bottles and cups after learning children could be exposed to material containing lead if the base breaks off the bottles. The U.S. Consumer Product Safety Commission said the company has received 7 reports of incidents, but no injuries have happened since this recall was put in place on November 23rd. Green Sprouts said it would issue a refund to customers who bought those products. Saz?
Protests erupted across China over the weekend as frustrated citizens expressed opposition to the country's zero COVID policy. Let's check in on how Washington is reacting to these protests with Yahoo Finance contributor Kevin Cirilli. Kevin.
So far, no direct word from President Biden on the protests that are being compared, quite frankly, to Tiananmen Square back in 1989. But we did get some forecasting, presumably, from what the administration could say on the Sunday shows over the weekend. In fact, the White House coronavirus response coordinator, Ashish Jha, told ABC This Week's Martha Raddatz, quote, "Obviously, that is not our strategy relating to the zero COVID lockdowns. We don't think that's realistic. Certainly not realistic for the American people. Our strategy has been build up immunity in the population by getting people vaccinated. That's how you managed an incredibly contagious variant like Omicron." Now, we should note that lawmakers do return from the Thanksgiving recess this week. And there's a lot of scrutiny, not just politically on what's happening in China, but also the economic impacts of that. Look no further than the reaction that we've seen from Apple and their iPhone production. And again, that continued exposed risk to U.S. supply chains as a result of increasingly unrest in China.
Kevin, separately here, Fed Chair Jerome Powell speaking on Wednesday. What are we expecting to hear?
Well, look, it's going to be his final public remarks ahead of that traditional blackout period before the mid-December meeting that he'll give. He's going to be speaking at the Brookings Institute. A lot of folks wondering whether or not that rate hike, the rate of the rate hike, is going to continue towards the end of the year. The economy does not seem to be going into as severe of a recession as the Fed potentially and Fed watchers had predicted, though they are still anticipating a downturn and a recession for next year. In addition to that, though, I mentioned China, the impact that China's supply chain policies and zero COVID policies has on the U.S. economy is something of an oddball, of an unpredictable wild card, so to speak, for the central bank to continue to monitor. And then separately from that, on Friday, we're going to get that jobs data. So again, some more economic indicators coming in this month as the Fed continues to face pressure on how they're going to navigate inflation.
And amidst that pressure, you're also watching some political pressure and various political showdowns into year end in Washington. What are you watching? What are those showdowns?
Jules, there's a lot. I mean, this lame duck they've got such a busy to-do list because they've got the lawmakers have to pass in the lame duck a government funding bill by December 16th, or the government's going to shut down. Not to mention that the stakes would even get higher should they not be able to do this in the new Congress, because Republicans, remember, they don't have as significant of a margin in the House of Representatives that they had originally predicted ahead of the midterms. So the stakes for the likes of Schumer, McConnell, Pelosi, and of course Kevin McCarthy, the core four, as I call them, they've got to pass this government funding bill, and then this other wild card that has emerged is the rail strike, because look, no one's anticipating that Congress isn't going to act should they have to as it relates to the rail strike, but it would occur likely in the same 10-day window as passing a government funding bill. So there could be a lot of high stakes political theater in the next 2 weeks in this lame duck.
All right, a little suspense here with these showdowns. Thanks so much, Kev. Appreciate it.
Keeps it interesting.
Yes, it does. Speaking of keeping it interesting, unfortunately, BlockFi, the latest domino to fall as a result of the collapse of FTX. The crypto lender is now filing for bankruptcy in New Jersey. BlockFi, remember, had halted withdrawals November 11th. That's the same day that FTX filed for bankruptcy, and now will join its fellow platform as it files for Chapter 11 in New Jersey. And in a statement here today, the company is talking about its restructuring efforts. It talks about that it has $256.9 million in cash on hand, which the statement says is expected to provide sufficient liquidity to support certain operations during the restructuring process. There's some other reporting that a number of folks are being laid off from BlockFi as a result of this. But the question that I don't see answered in here is whether people are going to get their money back. BlockFi is going to try to recover its funds lost from FTX. Right. But then do its clients receive money back from BlockFi? It's not clear to me from this statement whether they will or not.
Yeah, FTX had provided BlockFi with $400 million in this revolving credit facility. That was back in July of 2022. And then additionally, they had the option to buy the lender for up to about $240 million here. Now, of course, the downfall for FTX that we've seen also has brought to light the 50 top creditors that it owes, a sum of about $3 billion as well.
Yeah, our old friend Dan Roberts over at Decrypt, where he's the editor-in-chief, they're the actually ones that broke this story moments ago before it was confirmed with the press release. Dan, I'm following him on Twitter. To your point on layoffs, Julie, saying the BlockFi employees have begun receiving emails with their severance packages, so another tough situation as well over there.
Yeah, definitely a tough situation, one we'll continue to track.
Yeah, absolutely. Guys, coming up, why our next guest says that market volatility is a long-term investor's friend. We're going to discuss that next. Major averages lower here to kick off the trading week, but as we look ahead to 2023, our next guest says that high yield is compelling for long-term investors. Brandywine Global Portfolio Manager John McLean joins us now. John, make the case here for us and what particularly this could set up for some of those long-term investors.
Oh, absolutely. You know, for the first time in forever, we think bonds are interesting again. And in terms of the case, high yields never had back-to-back negative years, and we believe the valuation right now is compelling. So you're starting with a yield at close to 9%. That's pretty healthy. And investors should be focused on this all-in yield because of the move that we've seen in treasuries year to date. We think the duration is actually somewhat attractive in the marketplace. And really, this dollar price that we have now at 87 cents on the dollar allows for price appreciation as well as the coupon that you're getting. And what we talk about is yield to outcome opportunities in fixed income. So you may have a bond trading at 80 cents on the dollar and a company gets acquired. And what we've seen also, too, and we think this is really important, we're in the early innings of a monumental shift in capital allocation policy from corporations. So companies now are focused on living within a certain leverage target. They're focused on using cash flow to reduce debt as opposed to reward shareholders. And so now we've got corporate CFOs working for us as bondholders. And we think that investors should really jump on this.
I mean, John, when you talk about this big shift, right, it would be a big shift back. But in other words, everybody's saying this year 60-40 is dead, right, because the bond market has been such a stinker. So unusually a stinker along with the equity market. And what really stood out to me in your notes to us is you said 60-40 is alive and well. Not only that, it should be 40-60 next year. That feels like a pretty radical statement right now, even with the yields that you're getting on the fixed income side.
Well, I mean, that's one, we think fixed income is attractive, and two, we think equities are not attractive at this point. And it's all about valuation, again, at the end of the day. When you look at equities, I mean, I think we're going to go through this earnings recession. We've seen the earnings start to trend down here. We've seen, the consumer struggling a little bit. But, again, Fed policy leads to lagging effects. So I think what we're seeing now is really the result of the hiking that was going on 3 to 6 months ago. So we're going to continue to keep hiking here. And I don't think that companies are going to be able to continue to pass along the price increases that we've seen in 2022, in 2023, when the consumer is struggling a bit more. So as earnings go down, valuations need to come down. And again, I don't think that the Fed is going to go into a more dovish stance in 2023. So I don't think we're going to see interest rates go down in 2023. So now we've got a competitive good to equities. TINA's not the answer anymore. There is a competitive and compelling alternative to equities. And so we think you should be fading equities here and buying fixed income.
John, how do you think corporate bonds will perform next year if we do get a mild recession?
Yeah, I mean, we're set up, particularly in high yield, in a pretty attractive position here. So even if we get a mild recession, what you need to worry about from a lending perspective is, can companies continue to make their interest cost payments? And absolutely, companies borrowed hand over fist in 2020 and 2021 at particularly low rates. So it's like locking in your mortgage in 2020 at 2 3/4. You don't care that the market's now 7% for a 30-year fixed mortgage. You've got it at 2 3/4. So these corporations have cheap capital right now. They have no maturity wall to speak of. They have access to plenty of tangent pools of capital in the marketplace. And then from the asset class level, we've got commodity exposure in our marketplace. Energy is a big component of high yield. That's a tailwind as opposed to a headwind in prior cycles. You've got structural seniority in the marketplace, meaning that a lot of these lenders are borrowing senior secured. There's assets behind the debt. So we feel like your recoveries in a bankruptcy or restructuring would be higher than they have been in prior cycles. We feel very confident that this marketplace is set up to withstand a reasonable recession, particularly because we went through a default cycle in 2020. So the truly crappy companies in the marketplace are gone. And really, we've also seen the excess lending in the marketplace go to other areas like leverage loans and private credit.
Let's pick up on private credit for just a second here, because that area has really grown enormously over the course of the past couple of years, really taking on a lot of the credit market. What happens now? to that area?
It's I believe in Santa Claus, but it's marked to make believe in private credit right now. You had an asset class that's grown rapidly over a short period of time. It happened in high yield. It happened in leveraged loans. And the hangover effect is years of, challenging returns. And so we've seen this explosion in private credit lending. And, there's not as many good ideas in that marketplace. And what we've seen also is, look, we see what our market returns in the public sphere. And, high yield leveraged loans up 5-6% in 2021. And we're down double digits this year. Private credit was up 20% last year, and it's down low single digits this year. That doesn't make sense in fixed income because you have a contractual coupon, a stated final maturity. So as long as you avoid defaults, if you had a lot of winners in 2021, they're going to become losers in 2022. And we're not seeing that in this marketplace. And we also think that there's a lot of lending in software technology businesses in this space. And, we think that technology is really in for some pain going into 2023.
For what it's worth, John, I still very much believe in Santa and leave him cookies every single year, as I will this year as well. John McClain, Portfolio Manager at Brandywine Global. Always good to see you. Talk to you soon. Coming up, we'll toss it to Yahoo Finance Allie Garfinkel. There she is, waving to us, who is stationed inside an Amazon warehouse on this Cyber Monday. We'll be right back with that fun fact. Amazon is gearing up for a big cyber week, even as signs mount that consumers are spending cautiously this holiday season. Let's go right out to California, where we find Yahoo Finance tech reporter Allie Garfinkel inside an Amazon warehouse. Allie.
Hi, Brian. I'm here in Oxnard, California at OXR1, and I'm here with Pratik Dahiya. He is the general manager of this warehouse that's been ramping up for Cyber Monday. So Pratik, thank you so much for being here.
I appreciate it.
So tell me about what it takes to prepare from Cyber Monday from your perspective.
Yeah, Cyber Monday and Black Friday are one of the most important days for Amazon. It starts the peak season for the holidays. So really, a lot of things go into preparing for these amazing days. So starting with getting the right freight and all the inventory that consumers want to buy. So we started that about a month ago. Then we start hiring, which we ramped up around 1,000 associates here in this building. And then we, of course, start planning with our central teams and support partners, and of course our amazing transportation vendors, both at Amazon and outside, to start delivering those miles to our customers.
And you hired quite a bit, actually. You said in summer you had about 1,500 employees, and now you have about 2,500. Tell me about that process.
We are a relatively new building. We started in January of this year. So, of course, ramping up from 1,500 associates in the summer to about 2,500 plus was a great effort. And we really appreciate the community that we are a part of. So we hired almost 70% of our associates from this Tri-County coastal area, which is a part of Ventura, Camarillo, and Oxnard. So great efforts, word of mouth, the references from all the associates who were already working. And that's how we got here. And we're looking forward to ramp up again for the forthcoming peak seasons.
And talk to me about the stakes of this Cyber Monday. How important is Cyber Monday for you, especially in a holiday season where the consumer slowdown's really been something that's talked about?
No, it's super important. It's a very important day. Cyber Monday is traditionally one of the biggest shipping days for Amazon. And we started great with Black Friday. So definitely it sets the tone for the peak season, and we are looking forward to increasing demand from consumers. Amazon is still one of the best places where consumers want to use low prices and amazing selection and faster delivery speeds to get their gifts for their loved ones.
And then talk to me about, Amazon this past year has had some labor problems, particularly in New York, but I wanted to hear your perspective. What's your take on what it's like to work at an Amazon warehouse?
Look, Amazon believes in direct relationship with associates, and we believe in direct engagement, which has been very positive in this particular building for sure. As I said, we ramped up from 1,500 to 2,500 associates, and that's more from word of mouth. We see a lot of family and friend members working in the same building in the same shift. We have a great employee relation with them. We offer great benefits from insurance and also from amazing other benefits that associates can take discounts outside Amazon as well. So we had a great partnership with our associate, and we would not have ramped if that partnership did not exist between associates. So that's what we believe in, a direct relationship with associates and our management.
And last question, is there anything different about this Cyber Monday?
Well, I'm personally looking forward to some amazing electronic deals. So a lot of amazing deals in health and wellness. Of course, outdoor has been very big this year as people have started going out of the pandemic. So amazing selection. I personally have to look forward to that for myself, and looking forward to buy myself a couple of items this year.
Pratik, thank you so much. Back to you guys in the studio.
Thank you so much.
And thank you, Ellie. Appreciate it. Obviously, very busy day there. Let's talk about another big tech company, because in a surprising twist, Netflix had a strong showing at the domestic box office over the long Thanksgiving weekend. But is the movie business close to a full recovery? Yahoo Finance's Alexander Canal has the details on that. Allie,
No. And of course, the one streaming title is the surprise of the weekend. But if we take a step back and look at the overall box office, it really did disappoint. The box office totals grossed just under $93 million for the 3-day, $133 million for the 5-day. That's below expectations and obviously well below what we saw even last year when there weren't a lot of movies out, in addition to pre-pandemic levels in 2019. But if we zone in on probably the one good thing here, Knives Out, Glass Onion. That was a limited box office release, only 600 theaters in total, wasn't even available in every single state or city. That estimated between 12 million to 15 million in its 5-day gross. Now that's based on a variety of reports. Netflix has said that it will not be releasing the exact box office figures. We'll see if that changes. They could potentially change their mind given the success we saw here. But again, that's not nothing, and that's pretty pretty significant. Now, there were a few other bright spots when we think about some of the other movies that were out this past weekend. Black Panther: Wakanda Forever, this was in its third weekend, but it grossed an additional $64 million over the 5 days. So one good thing for Disney, but then one bad thing for Disney with the animated film Strange World, despite that A-list cast only grossing $18.6 million. It's estimated to lose $100 million in its theatrical run. So not something that Disney wants to see right now in the midst of all of their problems. And then Devotion, The Menu, Bones and All under $10 million. So, this wasn't a great Thanksgiving for the box office, and it should be interesting to see as we head into the Christmas season, as we head into the first quarter of 2023, how things could potentially change.
What does this signal to us for some of the titles that have been able to go to theaters, but then also make their way directly to streaming in a more condensed time frame? What does that signal to us about where the production houses and where the different streaming platforms may have to create even more of that kind of symbiosis going forward from here, knowing where the viewers are either staying or where they may be returning to some movie experiences?
Yeah, and it's an interesting question that I think all of the studios are grappling with. We heard last week that Amazon is going to spend $1 billion to produce 12 to 14 movies exclusively for theaters. That's based on a report from Bloomberg. So that could symbolize that maybe some of these streaming giants do want to see or experiment at least a little bit with the box office to see how that could add to profits. But in the same vein, with something like a Knives Out sequel that Netflix spent $450 million on to secure the next 2 iterations of that franchise, it begs the question, should Netflix have done a longer theatrical run? Could you imagine if it was in the 4,000 plus theaters that the rest of these movies were in and not just the 600 million? Maybe that could have been something that Netflix needs to explore, especially as that company has also struggled with free cash flow and profitability. So I think we're going to get more answers and more experimentation in 2023 when it comes to all this.
I mean, bottom line, my couch is pretty darn comfortable.
That's great.
And that's the thing.
And I know that Knives Out is coming eventually. I know that Strange World is coming eventually, right? And I don't know.
And I feel it with myself too. I'm getting a little lazy when it comes to the movies that I want to go out to the theater and see. There's a ton that I'm down, I'm browsing on my TV on my couch. And I'm saying, great, this movie is now available from the comfort of my own home. I'm going to watch it. And I think consumers are getting a little more picky. So if consumer behavior is changing, how does that change the way we think about the box office and the movies we produce?
Good questions, Allie.
Yep.
Thanks very much.
Don't have the answers, but
we will eventually.
Eventually.
Coming up, everything you need to know about gifting money this holiday season. Some important tips for you next.
And my cash out.
Let's turn now to another important part of the holiday spending season, gifting and charitable giving as well. The annual exclusion amount, that is the amount that you can gift in this tax year, remains at $16,000. Charitable donations, meanwhile, remain tax deductible. So let's tell you what you need to know about it. Christina Guglielmetti, who is CFP and president of Future Perfect Planning, is here with us in studio. Thanks for being here.
Thank you for having me.
So there's a lot to know about this stuff. So let's take the gifting part of it first. That is when you give people cash as a gift.
Yes.
What do people know? How should they be planning? Also, the holiday season creeps up on you. And then how do you figure out how to deploy cash if you want to give it in gifts?
Yeah, so as you mentioned, the gift exclusion this year is $16,000. So that means each giver can give each recipient $16,000 this year. And if you are married, your spouse can also give $16,000 to the same person. So if it's a situation where you're intending to give a big gift, let's say, for like a down payment for a house, something very generous like that, we're close to the end of the year. You may want to give part of that gift this year and part of that gift in January in a few weeks and take advantage of the $17,000 that limit increases to $17,000 next year. So that may be something that that would work for people who are giving larger gifts. And also remember that the gift is never taxable to the recipient. So it doesn't matter, how much money someone gives you, you're never going to pay tax on it if you're the recipient of that gift. When it comes to charitable giving, what mistakes do you see people making right now? Well, one thing, and I wouldn't call it a mistake, is there are a lot of scams out there, so we do need to be careful, that if you are going to give money or any kind of a gift, it's given to a reputable, legitimate organization. So that's one thing to always look out for. Unfortunately, this year is no different. There's always people taking advantage of people's good nature. So that's one thing, but you can also, and I wouldn't say it's a mistake, but there are some techniques and some strategies. For example, you can give appreciated stock instead of cash, and that can be a really good strategy. The market is down this year, as we all know, but there are still some pretty big gains from the bull market, from prior years, and for people who are sitting on large appreciated stock gains in mutual funds and stocks in ETFs, you can donate those shares, and that can actually be quite tax efficient. It's even better sometimes than giving cash, and then you can just buy back the same investment. If you still want to own it, you can always just buy it back. So that's a strategy that's a nice little technique that I think falls a little bit below the radar that a lot of people don't know about. But that's something that I tend to bring up with my clients a lot.
That's a really good point. And when you think about gifting perhaps a portfolio to someone, what is the best way to go about doing that?
Yeah, so that's a great question. So if you want to gift a portfolio to an individual, it's actually not usually a good idea to do that, to just give them the investments, because the cost basis goes with that gift.
Wow.
So if, and again, like I've seen this in situations with lots of clients where maybe they were given shares of stock that their parents or their grandparents bought even decades ago and, paid almost nothing for it. But now all of those embedded gains are still there. So it's a very generous gift, but it may not accomplish exactly what you're trying to accomplish. Whereas if you're making that donation to a charitable organization, the nice thing is that that tax gain gets wiped out. So you give it, there's no taxable gain for anybody to deal with. The organization gets the shares, and they can do with it what they would like. But if it's a situation where you want to give an investment to a person, it may be better to just give them the cash and have them just buy it directly.
Really excellent advice, and we're going to be heeding some of that going into this holiday giving period. Thanks so much for joining us here on set. Christina Guglielmetti, CFP and President of Future Perfect Planning. Thanks so much.
Thank you for all having me.
Absolutely. Guys, coming up, Elon Musk is moving forward with his plans for Twitter. We're going to discuss the latest next. Welcome back, everyone. Time for Cut for Time. 3 stories, 1 minute each. We start with this today. After a vast headcount reduction at Twitter, Elon Musk is looking ahead to his next course of action, hiring. The new owner of the social media network tweeted out slides addressed at a company meeting with the words, "We're recruiting," and the roles that they're going to be recruiting for, perhaps some of the most pertinent roles into making sure that they've got the necessary employees for just their day in, day out operations to avoid any type of pitfalls that would result in the form of privacy, security being compromised, or even where it could result in fines for the company too.
Good to see Twitter hiring some top performers. Get some top performers into that company, Julie.
Some people who like to be hard.
I'm just trying to.
Yeah. He also reportedly has been calling up company CEOs who have pulled their advertising from Twitter to try to convince them to come back. We'll see how that goes over, whether it's a soft touch in these calls or whether he's calling them up and telling them that they're anti-free speech and need to come back to the platform. We'll see how it goes.
Indeed. All right, saying all things Musk, Tesla's Model Y is speeding towards the top 5 best-selling models this year. But the price for the EV varies dramatically by country. Mainland China offers the cheapest option at just over $40,000, and Singapore checks in at over $103,000, making it the most expensive. Well, it's a pretty big difference. Those in Singapore really paying a lot for essentially the same car. It's the same car, right?
Well, does it depend at all on the option that you get? Is this all base model?
Yeah,
Model
I
Y?
think so.
Wow. Okay. Well, yeah, that's
Yeah, well, I mean, they're making them
car.
in China, so it makes sense that, that it would be cheaper where you're making it as opposed to, I think the import taxes in Singapore are probably substantial. I don't know. Reuters is also reporting that the Model 3 is going to get some kind of revamp, maybe even to cut some costs.
Sure.
To make that, so that could be quite interesting too.
There's already a lot of costs out of these cars. I mean, you just walk around and you see the interiors. I mean, Tesla's long been criticized for the fit and finishes on its cars. What else could they possibly take out?
Well, all the synergies that they had touted when they brought online the Model Y production was that 75% of the Model Y is actually just the Model 3. So much of it goes down the same line as well.
Yeah. All right. Travel's bouncing back to its highest level since 2019. Over 2.5 million people took flight yesterday. This comes as Frontier is hitting some turbulence after announcing it has transitioned to strictly digital communication. So we got 2 separate things here. On the one hand, travel's back to where it was, which is not a surprise to us, right? We've been talking to a lot of different travel executives. But then, speaking of cutting down to the bone, our friends at Frontier saying you cannot talk on the phone to a live person any longer.
I got to drop our man, Barry Biffle. I mean, he's been on with us a lot and ask him about this because this makes, I get it from a cost-saving perspective, but this is just a terrible move. You want to get blown up for Twitter for doing something wrong, this is probably going to be it. Imagine trying to call about a canceled flight or trying to get a refund. You're talking to a machine.
Right. And a machine who does not understand, especially if you're just forcing people to engage with chatbots in what is already a frustrating experience. If you get a canceled flight or delayed flight, going into the holiday period too, now what this means for travelers who are going to see increased delays. That's just a byproduct of what we see during holiday travel. And then you would have to just wait for a chatbot.
At the same time, when you call these airlines, you're on hold for hours and hours and hours. So that's the alternative, I guess. All right, coming up, Rochelle Akufo is going to continue our breakdown of those record Black Friday sales with an analyst from Moody's. You don't want to miss that. We've got stocks here in the red on this Cyber Monday.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast. I'm Rochelle Akufo, and here's what I'm watching today. Unrest in China rattling markets. The yuan dips, the yen catches a bid, and equities struggle to get out of the red as anti-lockdown protests spread to multiple cities in the aftermath of a deadly fire. We'll hear from control risks. And oil erases 2022 gains as the contagion spreads across risk assets. We'll look to other market drivers on this busy week. We have Fed Chair Jay Powell preparing to speak ahead of the Fed's blackout. And of course, Friday brings another jobs report. And of course, the fallout deepens. Crypto lender BlockFi files for Chapter 11 bankruptcy, becoming the latest domino to fall in the aftermath of FTX's collapse. We'll get analysis in this hour for you. But first, let's take a look at how the major indices are faring. As we can see, that all three major indices in the red there. We see the Dow there down about 0.2%. We see the S&P down just shy of 1%, and a similar situation there for the tech-heavy Nasdaq as well. Also want to take a look at what we're seeing with the sector action as well, because for most of the day, we've seen that energy has been in the red. That's down about 2.33%. And we're seeing that consumer discretionary is the only positive one. Also taking a look here, as you can see with Treasury yields, we did see a bigger spread between the 5 and the 10 and the 30 year, but that's come back a little bit though. As you can see there, the 5 year relatively flat today. And let's also take a look at crude oil. We know that that's facing fresh volatility as protests in China spark concern over demand. So let's bring in Yahoo Finance's Jared Blickery for more on this. Hey, Jared.
Hey there, just want to show you the sector action today talking about crude oil. Well, energy, which doesn't always move completely in sync with crude oil. Well, it is today. XLE is the worst performing sector. It is trading 2% to the downside, although I should note that over the last month, it's only the second worst sector. But of course, year to date, it is by far the leader here, up 62%. Now, let's take a look at the futures action, and we are going to go back to an intraday view. Crude oil, as I said, CL equals F. That is down about 1-2% today. Now it's trimmed those losses, only off about 0.6% today. You can see getting a little boost since U.S. equities started trading here. But I'm going to show you a longer term chart. This is 5 years, and $75 per barrel is an absolutely huge level. We have seen this in play as a former resistance point, as a former support point. So to fall below that, it leads to the question, have we found ourselves in a new range? Because that new range could go as low as these lows here, could go as low as 45. I don't know that we're going to see it play out that way, but definitely bears interest here. Also want to point out that we do have an OPEC Plus meeting next week, so we're going to keep our eyes on this.
And of course, a big importer of crude is China, and we understand that Goldman is out with a new note on the outlook for China. So what's the latest there, Jared?
Yeah, as you're seeing, China looking very green today, but in terms of the reopening picture, Goldman only sees a 30% chance of China reopening fully by the second quarter of next year. So that could mean some more downside. Now, what they do have going for them, the People's Bank of China has been enacting some stimulus measures recently. Those include a reverse repo cut but of about 25 basis points last week, also lowering the reserve requirement that banks have to hold in terms of customer deposits. All this means is that they're paying attention to the situation. Property developers got a 1.3 trillion yuan lifeline. So things are moving potentially in the right direction. We've seen some easing of the zero COVID policy, but with cases spiking to the highest levels ever, it is very uncertain how far this is going to continue. Rochelle.
Indeed. Well, thank you, Jared. Well, for more on the implications of these protests across China, let's bring in Dane Chamorro, Control Risks Head of Global Risk Analysis. Good to have you on, Dane. So obviously a lot at stake here for President Xi holding on to this zero COVID policy. Obviously, this is rare to see multiple protests at the same time on the same issue. What exactly is at stake right now for China's economy?
Well, it's as you know, China's been locked down, or a lot of large parts of China have been locked down for quite a few months now. You've seen this frustration boil over in the demonstrations that we're seeing in major cities in China, and that's really about the ability of people to go about their daily lives, to go to hospitals when they need to, quite apart from COVID, to run their businesses, to buy and sell, etc. And so this is the frustration that's boiled over. And your report earlier was saying, was alluding to what effect this might have on energy prices and other things should the lockdown be eased. And we also don't see the lockdown being eased until China really has an effective vaccine rolled out across a larger proportion of its population. It's really only begun that process. It's probably another 9 to 12 months before they can roll it out to a significant part of the population. So it has a huge impact, of course, on economic growth when large parts of the country continue to exist under various forms of lockdown.
So, Dane, do you think people underestimated China's ability to reopen while still holding on to this zero COVID policy? And what does this mean in terms of its role as a global growth engine?
So it's a great question. I mean, China's absolutely key for global growth, right? It's a huge share, anywhere between kind of 25, 35% of global growth, economic growth. So if you think about it this way, when the Chinese economy shrinks 1%, the global economy shrinks about 0.5%. But then there are major countries that are, major trading partners, suppliers to China, countries like Indonesia or Chile. Usually they're supplying raw materials. When China shrinks 1%, they shrink almost a full percentage point. So it has a huge impact on a wide variety of countries and economies around the world. So it's actually imperative that China get back to growth, to its more normal path of growth, and the new normal is kind of probably somewhere around 4%. It's not going to do that, of course, this current calendar year, and it probably won't do it next year, given how long it will take them to roll out this vaccine. But we do think that once they've done that, once they've got an effective vaccine to enough of the population, then you're going to have a big rebound in growth, because you've essentially had suppressed growth for, by that point, about 2 years.
And Dane, you mentioned companies within China, but what about multinational companies with exposure to China? Of course, primarily Apple, looking at perhaps 6 million iPhones produced being disrupted here. What does this mean for them and the message that this sends to companies with exposure there?
Well, most multinationals that were manufacturing, selling in China, or manufacturing for export from China, have suffered some form of supply chain disruption over the last 2 years at some point, because ports were shut down, because parts weren't available, because workforces weren't available. It's, of course, been the most extreme kind of in the last probably 6 to 9 months. You saw the demonstration that you just mentioned at the facility in Zhengzhou in northern China last week. And of course, that will directly affect that supply chain, but it's affected a whole variety of industries, domestically and for export. So it just means less predictability. And so what we see, of course, is a lot of multinationals, a lot of our clients looking at other jurisdictions, not to leave China by any stretch of the imagination, but simply to add on the margin to other jurisdictions so they have more resilience in the supply chain. And sometimes that's Mexico, and sometimes it's Poland, and sometimes it's Thailand or Vietnam. But it's not really leaving China. It's simply adding resilience by adding facilities and more capability to manufacture in other countries.
And are there other aspects of China's economy and financial system that are really being exacerbated by zero COVID that could have more spillover effects?
Sure. So we've seen it in the construction and the housing industry, which was, of course, it's kind of a systematic problem, and China tends to cycle through challenges with that industry every few years. It's of course exacerbated some of the problems in other parts of the economy. Retail, of course, takes a severe hit, and about half of the Chinese economy is retail, or consumption, if you will. And of course, when people can't move, when consumer confidence is at an all-time low in China, which it is now because of these lockdowns, that takes a big hit, and that's a big chunk of the economy. So it has very much exacerbated, some of these downward trends that we've seen in the economic sphere in China.
We'll have to see how this develops. We're continuing to keep an eye on it. A big thank you, Control Risks Head of Global Risk Analysis, Dane Chmura. Thank you for joining us this morning. All right, well, for today's chart of the day, we're taking a look at the MSCI China Index. Now, this chart from Bloomberg shows the performance versus the global index is now right back where it was before China's economy took off. That was around 2008. Now, the index stayed elevated for years and is now back to pre-boom levels. Now, that's as China's zero COVID policy continues to weigh on investors. Well, Apple may fall short of its iPhone 14 Pro production target by nearly 6 million units as one of its key manufacturing hubs in China faces unrest. Now, this is according to a report from Bloomberg. For more on this, let's bring in Yahoo Finance's tech editor, Dan Howley. So, Dan, what are you watching right now?
Yeah, that's right, Rochelle. This is basically a major blow to Apple as far as the iPhone sales go for the holiday period. These protests that we're seeing out of this Foxconn plant where workers are stepping out and saying, calling out the zero COVID policies have been going on for some time, where some workers have said, look, we're just going to try to take off in October. Some of them tried to flee the factory as lockdowns were going into place because of some COVID cases. They were also protesting against a lack of adequate food supplies. Then the company brought in new workers with the promise of higher wages just to ensure that they can get the work done that they needed on these iPhone units. And now these workers are also protesting against the policy. So this is a kind of ongoing problem that Foxconn is dealing with. And these protests coincide with other protests around the country related to the zero COVID policy. But for Apple, the factory issue is that this is the iPhone Pro model, the iPhone 14 Pro model, the Pro and Pro Max. Those have the higher selling price for Apple. And they're really the ones that have a different kind of setup. They have that dynamic island. They have the better camera. And so you would think that these are the phones that most people are going for. And in fact, Apple actually cut back on some of the planned production of the iPhone 14 Plus, which is not a Pro model, because it just wasn't getting as much attention as the Pros. So the fact that the Pros are really in danger here means that we could see a reduction in average selling price that we were expecting. 6 million units, nothing to sneeze at here. And so, for Apple, this comes at a terrible time, just because this is the holiday shopping season when they do sell a huge amount of their units and people are out there looking for them. They might just not have them.
I mean, tough news for Apple. We know they were really counting on those 14 Pros. Dan Howley, thank you so much. Right, well, concern over protests in China spreading throughout financial markets in this session. But one company bucking the trend after strong results is agricultural platform Pinduoduo. Now, the group beating forecasts with third quarter revenue growth of 65% on the year to just shy of $5 billion. Revenue from transaction services jumped an eye-catching 102% on an annual basis. Now, the company has, of course, been a beneficiary of severe lockdowns as consumers were forced to shop online. All right, coming up, a busy week ahead. You have Jay Powell speaking on Wednesday in what's likely to be the main event for markets. He's expected to solidify a slowdown in the pace of hikes, but is that the same as a pivot? We discuss next. Well, it's a big week ahead on the data front with JOLTS, manufacturing ISM numbers, and of course Friday's jobs report. But arguably, it's Fed Chair Jay Powell who will steal the market's attention, of course, on Wednesday. Now, he gives a final speech before the blackout period. He's expected to cement a slowdown in the pace of hikes, but my next guest says that doesn't necessarily mean a pivot. Joining me now is Jordan Jackson, global market strategist at JP Morgan Asset Management. Good to see you, Jordan. So break that down for us, because obviously there's a lot of nuance that people will be watching for in what we hear from Powell and a lot of the Fed speakers this week.
Sure. I think on tomorrow, the chairman is going to solidify smaller rate increases, but that doesn't mean an end to rate increases. We very well could see, at the very least, the Fed hiking rates over the next two meetings. So that's their December meeting, as well as their late January, early February meeting. But they could also be hiking very well into their March meeting as well. So over the next three meetings, again, they're more or less just shifting from a 75 basis point or 3/4 percentage point increase down to a 50 basis point, we think, in December, followed by potentially a string of 25 basis point increases over the first quarter of next year. You've also had some recent chorus or Fed speech suggest that rates might need to be north of 5%, right? And so that would maybe suggest a string of 50 basis point increases. So I think the markets are sort of welcoming these smaller increases, but we're certainly not out of the woods yet for higher interest rates.
And we have seen the market surprised a number of times, sort of jittery right before we get these announcements, and then exuberant, and then all of a sudden the panic sets in again. How do you think the markets are pricing in the risks at the moment?
Well, I think the markets are maybe sort of trying to balance, right? How far the Fed is willing to go. Do they go to 5%, right? Do they sort of stick maybe slightly shy of that 5% level and maybe go to 4.75% on the Fed funds rate? I think the markets are still pricing in something to the tune of around 100 basis points of cumulative tightening over this quarter and through the first quarter of next year. That again would suggest a 50 basis point move in December, followed by 25 in February and in March. And so the markets are sort of appreciating maybe the Fed being a little bit hawkish, but depending on, we get labor market data happening on Friday. That'll be the last employment report before the December meeting. A very, very strong jobs report could very well situate the Fed to potentially deliver more rate increases than what the markets are currently expecting. And so, again, it's just difficult for me to see an environment in which the Fed feels they're comfortable in at least pausing, particularly given that you still have inflation running north of 7%.
And Jordan, when you talk about the labor market there, and we saw with the labor participation rate, what is this saying about the effectiveness of the Fed when you look at what's happening with the labor market?
Well, the Fed is in a difficult position because we're still in this environment of excess demand for labor, right? Close to 11 million job vacancies, 6 million folks unemployed. So there's this pretty big gap in terms of the demand for labor. And what the Fed is really trying to orchestrate is bringing down that roughly 5 million job vacancy gap in a way in which that doesn't meaningfully push up the unemployment rate. We anticipate that the unemployment rate is going to bounce around between, call it 3.5% to 4% through the first quarter of next year before you start to see the unemployment rate tick up modestly over the back half of next year. And so this excess demand is going to take some time to work out. Really also what the Fed from a labor market perspective is they're particularly worried about wage inflation. And so if they can effectively bring down this excess demand for labor, that should cool the wage inflation numbers and helping to cool down a lot of the core inflation prints as we start to move over the course of next year.
And obviously you have this reduced spending power for consumers. Consumer confidence will also be coming out. What does this actually tell us about the state of the consumer when you factor in things like mounting debt and different ways that they're spending, not on discretionary, they're sort of putting some of these things on credit cards, and it does seem to have an air of desperation at the moment?
Sure. The way I would think about it is I think consumers are sort of normalizing their credit spending patterns, not necessarily becoming overextended. If you actually were to look at revolving debt as a percentage of disposable personal income, prior to the financial crisis, that number was around 9%. Coming into prior to the pandemic, that number was right around 6.5%. But we're seeing that number climb right to around 6%. And again, I don't think this is a sign that consumers are necessarily overextended. There are a couple of other additional tailwinds that may be hitting the consumer over the first couple of months of next year. One, you're going to get an 8.7% Social Security adjustment, one of the largest adjustments, COLA adjustments that we've seen going back to the early 1980s. The current administration is also talking about extending the student loan payments. So dual support there for consumers. And if we are still in an environment in which wages, at least nominal wages, are maybe trending lower, but still running to the tune of around 4.5%, 5%, we could be in an environment in which real wage growth potentially turns positive by the second quarter of next year. So the consumer still seems to be in decent shape. We're obviously watching some of the retail sales numbers over the holiday season to see if that trend continues. But it does seem like the consumer is potentially going to be the bright spot in keeping growth afloat over the next couple of quarters.
And we know that the Fed is saying the likelihood of recession continuing to grow. And as we take a look at what the bond market is indicating, do we have a sense of how deep a recession might be, or if the Fed will be able to pull off a soft landing and avoid a recession?
Sure. Well, one of the favorite indicators is the yield curve, the shape of the yield curve. And right now you have a very deeply inverted yield curve by measuring the difference between the yield on the 2-year and on the U.S. 10-year Treasury. That certainly has been a pretty good indicator of a recession in the past. However, the depth of the inversion has never been a decent indicator in terms of determining the depth of the recession. We're still in the camp that the recession is going to be relatively mild, maybe a bit prolonged, lasting a few quarters, but still a relatively mild one. And we actually think, again, one of the bright spots continues to be the labor market and the consumer. Maybe most of the weakness actually materializes in sectors like the housing market, as well as in overall business capex. So again, we're still in the camp of a relatively mild recession, even though the bond market may be signaling something, maybe a worser outcome.
Well, great to get your insights, Jordan Jackson there, global market strategist at JP Morgan Asset Management. Thanks so much. All right, coming up, BlockFi files for Chapter 11. We'll discuss crypto contagion and price action as Mark Mobius and Kathy Wood offer very different perspectives on the future price of Bitcoin. So who's way off base? We'll talk crypto next. right, well, let's get you a check on what we're seeing with crypto. We're seeing Bitcoin under pressure, down more than 3% there. As you can see there, Ethereum also under pressure to the tune of 5%. Hasn't been able to bounce back since the Ethereum merge. You have Solana down 9%, Litecoin down more than 7%, and Dogecoin, a Musk favorite there, down more than about almost 12% there. Now, this is all happening, of course, today as we get more contrasting calls on the future price of Bitcoin. On one hand, you have legendary investor Mark Mobius saying it could fall to 10,000, all the while Cathie Wood sticking to a big call of $1 million for the token by 2030. Well, lender BlockFi is filing for bankruptcy. BlockFi had halted withdrawals November 11th, the same day that FTX filed for bankruptcy, and now will join its fellow platform as it files for Chapter 11 in New Jersey. Well, our very own David Hollerith is following this story and joins us now. So, David, what's the latest?
So we just picked up the filing, and it shows that BlockFi has anywhere between $1 billion and $10 billion in assets and liabilities, and that's for more than 100,000 creditors. And notably, BlockFi was facing similar financial woes over the summer. We saw the bankruptcies of Voyager Digital and Celsius Network, both competitors to BlockFi during that time. And BlockFi received a bailout from FTX in the nick of time, so to speak. And that was a $250 million line of credit that they received from FTX. In a statement, the company cited that a lot of the bankruptcy is related to the amount of credit that they're using to run their businesses in FTX's bankruptcy. So this was definitely expected at this point. BlockFi obviously did pause withdrawals. The company did say in its filing that it has $256 million in cash to support itself during the operation. So not a surprise, obviously, not great to see another bankrupt crypto firm. But the one thing I will point out is that this is a little bit more about a firm being in the wrong place at the wrong time and getting the wrong cash from the wrong people, as opposed to what we saw over the summer with Celsius Network, which looked more like mismanagement in terms of management practices.
Certainly not helping at a time when people are looking for a lot more trust in the crypto industry. Also want to look at what's happening with Bahamian authorities. They're working on an investigation into FTX. What's the latest there?
Right. So last night, the Attorney General for the Bahamas released a statement sort of addressing the nation's investigation into the FTX collapse. FTX is known to be headquartered in the Bahamas, and the Bahamas has claimed jurisdiction over at least one piece of FTX's affiliated companies under bankruptcy. So here's the statement from the Bahamian Attorney General. Here's what he had to say.
It is extremely regrettable that in Chapter 11 filings for bankruptcy protection made in New York last week, that the new chief executive of FTX Trading Limited, not the Bahamas-based FTX Digital Markets, but an affiliate company incorporated in Antigua and Barbuda, misrepresented the timely action taken by the Securities Commission and used inaccurate allegations lodged in the transfer motion they had filed to do so. It is possible that the prospect of multi-million-dollar legal and consultancy fees is driving both their legal strategy and their intemperate statements.
Yeah, so just to wrap up, what he was addressing is he was sort of speaking out to FTX's new CEO under bankruptcy who's been appointed. And there's been a dispute between the Bahamas and the U.S. Lawyers representing FTX. And it's mostly looked like a dispute over jurisdiction for this one part of FTX's business, and potentially just comes down to, which jurisdiction's lawyers get the legal fees. But in U.S. filings, FTX lawyers have made the accusations that Sam Bankman-Fried, the former CEO, has been sort of in league with the Bahamian regulators. And of course, this is an accusation and it's not necessarily verified, but there is the split that's playing out. And we're obviously keeping close eyes on that.
All right, well, thank you for getting us up to speed on that, David Hollerith. Thanks so much. All right, coming up, ahead of the game, online shoppers hit the sales hard on Thanksgiving Day to get a jump on Black Friday. So how's Cyber Monday shaping up? We'll get into the retail conversation next. Shoppers got busy the day after Thanksgiving this year, and they didn't even have to leave their homes to do it. Online sales set a new record on Black Friday, topping $9.1 billion for the first time ever. That's according to Adobe Analytics. And Cyber Monday sales are expected to continue breaking online shopping records. But our next guest isn't too optimistic about the retail sector long term. Joining me now is Christina Boni, Senior VP at Moody's Investor Services. Now, Christina, you've actually lowered your 2022 forecast for retail and apparel. What are the factors driving that?
Yes, well, it's still a very difficult operating environment for retailers. We're still seeing a very over-inventoried situation. Supply chain challenges earlier this year left retailers with just too much inventory, and the perfect storm came with the consumer starting to slow at the exact same time they were getting this inventory.
So then when we actually take a look at these Black Friday sales, when we factor in inflation, how successful actually was it?
Well, it's early days. We haven't had normal traffic patterns in a few years now, given the pandemic. So we are seeing that the consumer wants to be out, wants to be back in stores, wants to get back to their normal patterns. What will be the telling signs is as we move into the December period and we go into that traditional lull before we get to the days prior to the holiday itself. So it's early days. This is just one component.
And in terms of some of the sales that we're seeing, we saw that Walmart dominated Black Friday searches, up 386% year over year, according to Adobe. What is Walmart getting right? I know we talked about inventory, but what is Walmart doing right, you think, versus other retailers?
Well, Walmart is skewed towards those necessities, and we're seeing that consumers are very focused on necessities at this point, given that their wallets are being eaten by energy and food. And Walmart is big in the food category. So that's part of it. And they're providing value. And we're seeing that even the high income consumer is starting to skew and move towards looking for that value.
And it's interesting because as we look at what people were spending on, electronics, toys, and exercise equipment were the biggest sellers, up more than 200%, and more than that actually, versus a typical day in October, according to Adobe. But where is the bulk of this discretionary spending coming from? We keep hearing this tale of the two sets of consumers.
Well, two sets of consumers, meaning that lower income consumer is seeing their wallet being shrunk. And the high-end consumer has still had significant savings. And we've seen that in recent months that the savings are continuing to decline, that there is economic uncertainty out there. We are predicting that unemployment is also going to continue to rise. And all that factors in to how the consumer is willing to spend.
And so when do you expect that tide to turn? Because the consumer is still resilient at the moment, but as we see a rise in buy now, pay later, a rise in more credit card debt, how long can the consumer keep this up, do you think?
Well, it gets more challenging. The consumer is also looking at such high price increases. And as we go into next year, inflation is moderating, but there is still significant pressure on price. And it's going to be very difficult for retailers to take more pricing. So we're seeing that pullback in units. Even though we see sales rising, it's not units rising, it's actual inflation that we're seeing. The consumer is spending more, but getting less.
And we know that this spending started before Black Friday. The sales seem to come earlier and earlier. So then by the time we factor in Cyber Monday and the credit card bills start coming due at the beginning of January, then when do you think all of this is going to start coming into better alignment?
Well, I think as we go into next year and we start to see that costs are starting to decline, we're seeing that ultimately that there won't be as much pricing pressure. That will help the consumer. But unemployment still remains a factor. We're still seeing the Fed continuing to raise rates. All those things really factor into how the consumer's wallet is and what the consumer is willing to do. Our negative outlook is basically looking for that the first half of next year is going to be challenging.
We'll certainly be keeping tuned to that. A big thank you, Christina Boney, there, Senior Vice President at Moody's Investor Services. Thank you so much. Right, well, the world's largest e-commerce company is calling it quits on its food delivery business in India. Amazon confirming to Reuters that it will shut down Amazon Food by year's end, which it launched at the peak of the pandemic in May of 2020. And the move comes after the company announced it's shutting down its edtech business, Amazon Academy, as part of its cost-cutting measures. Earlier this month, it announced it was laying off over 10,000 employees due to uncertain macroeconomic conditions. So clearly still biting Amazon right now. All right, coming up, our agents will not speak with you now. Frontier eliminates its customer service help phone line, so if you need assistance, you'll need to speak to a help bot or jump on WhatsApp. We'll talk airlines and cost cutting next.
What we're looking to do is add more value for the overall travel experience and sell them more and more options. And that just enables us to further lower our fares and enable more people to travel. What we can do is continue to provide other valuable services and products so that we can kind of offset that, and so we can enable more and more people to fly.
Well, that was Frontier CEO Barry Biffle earlier this month on how his airline hopes to rein in spending. And we're seeing him follow through on that promise now, with the airline on Friday switching off its customer call center. Here with more is Yahoo Finance's Brad Smith. Brad, I know this isn't welcome news.
This is not welcome news for people who are gearing up to travel. PwC anticipates that 47% of Americans will be traveling this holiday season. And for the passenger disruptions in the form of delays or cancellations that we've seen over the summer, this could be some unwelcome news for potential travelers who are leveraging some of the Frontier Airlines routes in this holiday season. Now, what's more about this, we do have a statement from the company as well here, and it is noteworthy that the company had said within this and within some of these plans, as a result of their function in customer care, they're transitioning to digital communications, fully digital communications. So just think about some of the experiences that you've had within the chatbots, or just getting an automated line. And sometimes that's not necessarily the most human touch that we may get over the course of some of our travel hiccups, but at the same time, it is this push for Frontier to really trim some of the costs, to be a little bit more efficient and leverage some of the data that they've seen even in those communications with customers as well, saying that most of their customers have actually leaned into or preferred some of those digital communications. So perhaps some of their chatbots over at Frontier are just a little bit better than the rest of the industry. But again, this is at a time where we're seeing some of the industry actually get back up to its pre-pandemic throughput, depending upon the day that you're kind of comparing it to. We've actually seen the highest number of travelers just in the most recent days than we have since the time pre-pandemic. And so with that in mind, we're going to be watching closely to see where some of those travel experiences improve, where they hold steady, or where there might be some more headaches that are on the tarmac going forward as we get towards some of the peak holiday travels, even as we're coming off of that Thanksgiving high of travels as well, Rochelle.
And it's interesting because even though consumer demand is still strong, consumer satisfaction with airlines taking a downturn. So I'm just picturing people sort of screaming into the phone, customer service, like 10 times, which is what they tend to do when they're trying to just reach a human being and resolve things. Do you think then customer service satisfaction might suffer then, perhaps if you're new and you're not someone who likes to lean into this sort of technology?
That's a great question. I think consumers will also need to scream serenity now into some of those phone calls as well, because that's what they're going to need as they're going throughout some of these travel experiences over the course of a high demand travel period. And what we've heard time after time again from some of the travel CEOs, whether that be the Hilton side of the equation on the accommodations industry, or even within Airbnb, as we were speaking with Brian Chesky just a couple weeks back. And then additionally, you think about some of the commentary that we've heard from airline CEOs over this recent earnings season. They're all talking about this increased travel demand, this shift from spending on goods to services, and this golden age of travel, as Chris Nassetta over at Hilton had described it to us during the Yahoo Finance All Market Summit as well. And so with that, and that increased era of demand that they're seeing, how will they also ramp up the customer experience side of the equation too? Because there is still a value that consumers are looking for, even if they are paying up because of that higher demand period too. And so locking in that value, locking in that experience is still going to be core to retaining the Net Promoter Score, positive Net Promoter Score. And for Frontier, it'll be interesting to see how this strategy plays out for them, especially coming after they hadn't been able to move forward that acquisition attempt for Spirit Airlines as well. And so now some of the cost cutting starts to come into the equation, and we'll see where that value payoff for the experience really holds up for their passengers as well, particularly on this news headline.
I mean, it's true. And as we're seeing, people willing to put up with a lot for a good deal. So clearly demand not going anywhere. Yahoo Finance's Brad Smith. Good to have you.
Thanks.
All right, let's turn now to a wider look at the airline industry. Air travel hiccups during the Thanksgiving holidays causing more than 4,000 delays, according to FlightAware, as record travel numbers return. Now, while some delays were attributed to poor weather, fears remain of whether the industry is staffed and set to handle the crush of travelers set to fly in December. Well, joining us now with a look at the industry is Connor Cunningham, Milius Research Director. Good to have you on, Connor. So were you surprised that some of these airlines and airports weren't as prepared as expected, given that travel demand really hasn't declined anytime soon?
So I realized that there was a fair bit of delays yesterday. That was weather related. Honestly, I thought the operation over Thanksgiving was pretty good and almost, I would argue, exceptional for what they could control. The airlines have really pulled back capacity and allowed the staff properly at the airports and so on. So the operation has actually been pretty good since August, and we've been really encouraged with what we're seeing. Our thing historically about the group is really like, we're not concerned about the demand picture. Demand is there, as you were just talking about. We're in a travel renaissance right now. It's really whether or not the airlines could kind of execute during that time frame. We had a lot of issues over the summer that caught a lot of the airlines by surprise from staffing and so on. But since August, again, I think the stuff has been very good. Again, there were some disruptions for delays, but not a lot of cancellations yesterday. So I was pretty encouraged about what we saw there.
So Connor, what are your expectations then as we head into December? Any sort of disruptions that we should be bracing for there?
Yeah, I mean, I think that the fourth quarter in general is dictated by peaks. So the airlines need to execute over Thanksgiving, over Christmas, and then the off-peak timeframes are generally when business travel kind of fills in. I think that the airlines are hyper aware of that they need to execute over Christmas, and we'll staff properly. So I'm not really concerned about that. Whether can blindside the group at any moment, but from what they can control, things are pretty good. What we're mostly focused on right now is more on the off-peak. So corporate travel again is generally when it fills in on these off-peak timeframes during the fourth quarter. That's been a little weaker than we would have liked to see. So there's been several weeks of declines, but the peaks overall, what defines the fourth quarter are very good. I think Hopper's out there saying that the average ticket fare is going to be $460, give or take, over Christmas. So things are pretty good from a demand standpoint. It's really about executing going forward. So that's what we're focused on right now.
And Connor, as you mentioned business travel, is there an expectation that it will ever return to pre-pandemic levels? And what is it actually going to take to get there now that people have sort of gotten comfortable with this hybrid model?
Yeah, not too long ago, people were talking about the demise of business travel, Zoom being, the thing that we talk about a lot. And, that there is a portion of the travel environment on the corporate side that's going to not come back fully as a result of that. The going in for a 6-hour flight to come back for one trip or one meeting is not probably done. But business travel will fully recover. It's just going to look a little bit different. There's been a lot of talk of hybrid itineraries, so people that go out for corporate travel, but also kind of blend in a leisure trip on top of it. So it actually creates incremental travel demand overall. So it's just going to look a lot different. The environment is always going to evolve. Travel it tends to fully recover at some point. It's just a matter of time. So I do fully expect corporate to come back. It's just going to take a little bit, but again, do I expect it to be fully or to not recover to 2019 levels? No, I do think it will. It's just a matter of when. I think next year into January is kind of really when we start to see another uptick in demand from the corporate standpoint. Again, assuming that the economy doesn't fall apart and there isn't a massive layoffs and so on, corporate travel should recover into next year. And we'll start to see another step function change in early 2023. So we're looking towards that. But yeah, from third quarter to fourth quarter, not going to be a huge increase. There's no reason for it, but really next year is when we're looking for another leg up in the recovery phase.
And Connor, just quickly, you say that you're increasingly cautious as you look into 2023. What is giving you pause, and how does that differ domestically versus internationally with travel?
Yeah, so I think we're in the best revenue environment in airline history, and so it's hard to kind of imagine that kind of continuing into through a recession if we do hit one in next year. So we're looking for unemployment figures and whether or not those actually change or not. That's probably the biggest trigger to slow consumer spending overall. But really what's making us incrementally more cautious is just labor contracts are open. Pilots are going to get paid a lot more money, and it's getting increasingly more expensive, every month that we kind of flag on. So the upside from the revenue environment could be capped now, and we could see incremental cost headwinds from a non-fuel standpoint. Fuel in general has ticked down. That's been a positive thing overall, and will be supportive of margins in the near term. But I think that the group will generally, trade more on the revenue environment, and then the actual controllable cost side of the equation from the labor standpoint and so on. So that's really what we're focused on again. So, our preference, I think, is really more towards internationally exposed airlines that still have yet to fully recover. So Delta, United are our top picks in that environment. And then domestically, I think that you're already seeing full recovery. Leisure really isn't going to get any better. It should be, as long as it remains solid, it should be good for Southwest and Alaska. But really, the further iterations of the recovery are going to be on corporate and international going forward.
All right, well, certainly lots to digest there. We do appreciate you joining us. Connor Cunningham, Milius Research Director, thank you so much. All right, coming up, the beautiful game gets more political. Iran calls for the United States to be kicked out of the World Cup after it altered the nation's flag. We discuss the tournament's impact on international relations next. Now the World Cup and politics. The US men's soccer team is being singled out for altering the Iranian flag in a post on social media. Well, what's it all about? Yahoo Finance's senior columnist Rick Newman has the details. Hey, Rick.
Hey, this is fun. So the U.S. men's national team posted that picture of the Iranian flag without the crest that represents the theocratic government of Iran. You can see the real flag there, and they posted it without that crest. If you take the crest out, that is the Iranian flag from before 1979, when the Iranian Revolution happened and the theocratic government came to power there. So they're trolling this team, and these two teams are actually playing each other tomorrow. So this is sort of a version of two teams trash talking each other, except it has geopolitical implications. And Iran has fired back and said that the United States doing that is a violation of the Soccer Federation's rules, and that the Soccer Federation should kick the United States out of the World Cup. Fighting words going both ways.
Indeed, certainly a lot at stake here. If you think it's just a simple football match, certainly not the case. All right, thank you, Rick Newman there. Well, before we go, let's do a quick market check, see how the markets are faring at the moment. As you can see, all three major indices still in negative territory, accelerating losses a little bit there. You see the Dow there down more than 240 points, the S&P down about 30 points there, about 0.7%, and the tech-heavy Nasdaq down by a similar amount, 0.7%. Well, that'll do it for now. I'm Rochelle Akufo. I'll see you tomorrow at 11 a.m. Eastern. Have a good one.